All right. So everyone in the class, very good morning. Welcome to this amazing session of full English revision for the chapter of portfolio management. Yes. So in this chapter of CA Final AFM, we're gonna discuss all the concepts for the exam and also solve the needed number of questions, at least one question of each type, to make sure that you have a good comfort over the concept, you have that needed conceptual clarity, and also the application of the concept on the questions. Yes. So who all do we have in the class today? People. So let me just confirm if audio, video, everything is clear or not. Just give me a minute. Just give me a minute. Let me just confirm. Guys, just a second. Perfect. Great. Sorted. So very good morning, everyone. Now, just for your information, we gonna refer, what all do we gonna refer in this? Sir, first, our amazing OutNotes, the concepts notes that we use for all our batches, regular batch, power batch, exam oriented batches. These notes is what we will refer in the class. For example, you can see here on the screen, these are the notes that we gonna refer. Right. Then the question bank is called as OutScanner, which is compilation of all the questions from RTP, MTP, exam paper, study material, etc. These are the same notes which are again referred by all our batches. These two notes, the soft copy is available in the description of this video, right? There's a possibility that you'll watch this video, for example, after a year. So by then there will be an updated version of OutNotes and OutScanner, which you can download from Telegram. The link which I give you right now are the notes which are the latest one, but that is from Jan 26 point of view. Now for example, you watch it for Jan 27 or onwards, then there will be a further updated version of OutNotes OutScanner, which you can also download from the Telegram. Perfect. That is one thing. Second, let me tell you, I am also attaching link of the playlist which has compilation of all these revision videos. We are already done with derivatives, we are already done with forex. This is portfolio management. We have plans to come up with such revisions for other chapters as well, right? So everyone in the class, let's get started and start to discuss what this chapter has to say. Yes, broadly, overall, three categories the entire chapter has been broken down into: modern portfolio theory, Sharpe index model, other important topics. More than these categories, this individual topics names are important, because this is how you'll be able to remember them. The very first thing that we're gonna learn in this chapter is that for a single security, how do you calculate return, how do you calculate risk? Then for a portfolio of securities, suppose a portfolio has 2 security, 3 security. In that case, of that entire portfolio, how do you calculate risk and return? This is the most basic and primary learning that we need to take. Sir, let's get started. One basic thing. Whenever it comes to calculating return, right, that is the first step, because even the calculation of risk can happen only after you have calculated the expected return. So first thing is calculating the expected return, which is always denoted like this: expected return of a security A or expected return of security B, right? Sir, this is calculated using two possibilities depending upon what kind of data examiner has given. Examiner might give us the data of past, or it might give us the data of future. What exactly data examiner might give? Examiner can give you the data of prices and dividend. For example, imagine in case of past, which is called as exposed data, right? In case of exposed data, examiner has given to me the prices of past 5 years, the dividends of past 5 years. So using this particular formula, which is P1 minus P0 plus D divided by 0, divided by P0, I can calculate the returns that a particular share could earn in the last 4 years or 5 years, as the case may be. So this is a generic formula to be used every time you have to convert price and dividend data into the return data. So for example, you have calculated the returns for the last 5 years or 4 years using this formula. The returns so calculated is called as possible returns. What do you call them? Possible returns. How do you denote them? You denote them by X. To be able to get the complete rhythm of the chapter, you'll have to be there in this video for the next 15 minutes. Then only you will be able to better understand what I'm trying to speak. Yes, because in this video, we're gonna make sure that you don't have to mug up the formulas except for 1 or 2 or 3 formulas where it is all derivation, where the derivation is actually all mathematical. Except for those 2-3 formulas, you'll be able to understand the entire chapter without any mug up at all. So live people, who all do we have in the class right now? Please say something. Good morning, guys. Please tell me so that we can connect. Who all do we have? Come on. So bringing you back, I want your attention specifically so that we can learn to create the formulas at our own without any need to mug it up. Yes? Great. Lakshmi. Lakshmi is your first name, right? Very good morning. Perfect. So bringing you all back. Come on, people. So given the data of price and dividend, we can calculate the return of different years. We call them possible return. Similarly, everyone in the class, there is a possibility examiner may give you ex ante data. See, ex post data is the detail of price and dividend of past years. Ex ante data is the detail of possible prices that we can have in the coming year and the probability of them happening. We have been given the data of future. So today price is, for example, 100, right? On the timeline, you can imagine it like this. In case of past data, I stand here. Examiner give me the data of previous prices and dividend. In case of ex ante data, you can imagine it like that. This time I stand here. In the future, what can be the possible prices and what can be the possible dividends and what can be the possible probabilities of those prices and dividend? That is what examiner give me. Even if it is the data of future, even if it is ex ante data, you can use the same formula to calculate using those possible prices. You can, using this formula, for every probability, for every possibility, you can calculate the possible returns, again denoted by X. Meaning to say, X is referred as my possible return, whether it is the data of past or it is the data of future, and using this formula we can calculate those possible returns. Yes. Now starting officially with how do you calculate the expected rate of return, which is nothing but, everyone in the class, average. Expected return is nothing but the average of all such possible returns. If it is the data of past, let me now take you to the table. For examiner gives me past 4 year, its possible prices, its dividend, right? More than calculation, try to focus on the flow. Right? If needed, we will also do the calculation. You should keep specifically your calculator ready in portfolio management, because unless you do, you don't get that confidence of doing it at your own. Right? So everyone in the class, sir, if the data of 2021's price is given, can I calculate the return of 2021? No. Because for that I need 2020's data also. So I can calculate the return for 22, 23 and 24. Right? For example, in the first year it will be 120 minus 100 plus 5 divided by 100 give me 25% return for 2022. I will call it as possible return denoted by X. Similarly, for 2022, return is negative 25. For 24, return is negative 30. So past 3 year, 1 year, 2 year and 3 year, these are the returns. I stand here. I have to predict the return for the next 1 year, called as expected rate of return. That in the coming year, for the next 1 year, what is my expected rate of return? Simply the average of 3 past possible returns. So 25, 20, 30, when I average it out, it becomes people in the class 10%. More than max, the ability to understand formula is really important. If x is my possible return, then can I say average will be sum of all of them divided by 3? So if this is x, the summation will be called as, the addition of it will be called as summation of x. So average, if this is x, the average of it will be x bar, which is calculated as 30 divided by 3, which is summation of x divided by 1 to 3. So divided by n, giving me 10%. This is my expected rate of return. With this mindset, if we proceed ahead, you will be able to make sure that you all understand the formula really well. Now, similarly, sir, if I have two securities, which means there is one security A, another security B. So if the possible return of X, security A is X, the possible return of another security will be considered Y. The average of it here is X bar, so the average there will be Y bar, and so on. Correct? Sir, if it is the data of future X, enter data if it is Z, along with the dividend and weightages, how do we do? At 0 point, the price is 100. In the next year, for the next year, the possible price is going to be 90, 110, 50 with this probability and with this amount of dividend. Let's say for this scenario, let's calculate a possible return. So it's like 110 minus 100 plus 5 divided by 100, giving me 15%, 15% possible return. Are you understanding? Sir, similarly for this scenario, return is negative 10%. For this scenario, return is 25%. Again, I'll have to do average, but please observe. In the exposed data, I did not have any probability of past. So I did a simple average. I divided by 30 with 3, giving me a simple average of all past possible returns. This time for future, I have the probability of their occurrence. So 10 will be the return, negative 10 has 20% chance, 15 will be the return has 50% chance, 25 will be the return has 30% chance. So on a weighted average basis, what is the return? Weighted average basis, what is the return? Sir, if P is probability, X is possible return. So can I multiply return with the probability, naming this column as P into X, right? And I am repeating the same flow that you have learned in the regular or exam oriented batch. Jai, very good morning. Come on, everyone in the class, who all do we have in this live class right now? Come on. Those who have joined, let me first of all tell you, those who have joined late, please come to the latest point where the lecture is going on. In my watch, it is right now 9:27. If you watch it with a lag of say 10-15 minutes, so I would suggest you to come to the latest point so that we are able to communicate live. In the chat box, everyone please mark your presence, and those who have started watching this video without liking it or without subscribing this channel, let me tell you again a small story as I tell every time. There were two students. I had two students in one of the attempts. Both the students work really hard, right? Exceptional. The only difference between the two were one did not subscribe the channel and another did subscribe. You know what happened? The one who subscribed the channel could secure 80 plus marks with the same knowledge. And the one who did not could secure only 40 to 50 marks. You know what is the difference? Blessings, wishes, prayers. Well, I say this small story in all the revision lecture. The point is simple, jokes apart. When you subscribe, it really motivates me to do better for you people. Yes. Sir, so bringing you all back to the point, always there, Lakshmi, irrespective the blessings are there, you subscribe it or not, every student watching this video, I will have my blessings to you. That whenever is your attempt, you make it really great, big in that attempt. That simple it is. Okay. So if P is probability, try to get the flow of it because that has what been taught to you in your regular exam oriented batches. The same flow we will follow now. Sir, if P is the probability, X is the possible return, the next last column will be P into X, probability into X, right? And weighted average will be sum of it, for example, 10 into 20% plus 15 into 50% plus 25 into 30%. When you do all them, it become the weighted average become 30. Now look at the name. ERA is expected return of security, which is nothing but average. So if this is X, average will be X bar. Sir, how did you calculate X bar? Summation of 13 is what? Is addition of summation of which column? P into X. So summation of P into X automatically become the formula. So did you observe something? Whenever we have to average out, if it is the data of past, we will do simple averaging. In the table, averaging won't happen. Table is going to give me total. That total will be divided then with the number of observation, the number of year to get the average. Whereas in case of X ante data, since we have given the probability, we have been given the probability of its occurrence, right? Since we have been given the probability of its occurrence, let me tell you, the averaging happens in the table itself. When you do the total of it, it is not the summation of all the observation, it is the average only directly done in the table after getting multiplied with the probability. Yes? So a lot of people think that portfolio is about the formulas. No, it is also about the timelines if you have that intention to learn it in that manner. Yes? You get it on the timeline so that we are able to create the formulas better. Sir, that was about the return of a security. Now I'm going to teach you the risk of an individual security. Right? Sir, I give you simple example. There is this security, both of them are trading at rupee 100. We see that after a year it is expected to become 110, 100 or 90. Where another security is expected to become 150, 120 and 60. Which security deviates more? Which security deviates more? Sir, this one, which is why it is more risky. So risk is measured as deviation. In statistics, how did we calculate deviation? Sir, standard deviation. For example, let's take the same data. There are 3 years, 3 possible return. The total was 30, the average was 10. We are settled. Now let's find out how much. Listen to my words. When you listen to this, it creates the formula. Now we need to find out how much are these possible returns deviating from the average of 10. Let's observe how are these individual possible returns deviate from the average of 10. So we will say 25 minus 10 is 15 deviation, minus 25 minus 10, minus 10 is 35 deviation, and 30 minus 20 is 10 deviation. So these are the deviations of these individual possible returns of past 3 years. I need to find out at squared level how much is the deviation. So squared level 225, 1225 and 400 is the deviation at squared level for these 3 possible returns for the past 3 years. Now sir, now I need to find the average deviation. This is the total deviation of all the possible return. I have to say a single number that how much is the deviation, I will have to average it out. So now look at the beauty of columns. Dx, you don't need to write to the examiner x minus x bar. What was the formula? X minus x bar. X minus x bar. But what do I call it? When I do x minus x bar, I call it deviation of x from x bar, calling it to be dx. If this is dx, the next column automatically is dx square. If I have to calculate the average dx square, can I say will be nothing but summation of dx square divided by n, giving me average. So 1850 divided by 3 years, everyone in the class is 616.67 square. Do you know what is this average deviation at squared level called as? It is, people in the class, nothing but variance of security A, which is represented as sigma of security A at squared level. Right? Similarly, just give me a minute. Similarly, Will you give me a minute? Please give me a minute. Sorry. Give me a minute. I have to take care of something. Just 1 second. Sorry, where I was with you people. So, are you all there? Everyone? So sorry, I am back. Just give me a minute. My voice would be less audible because the mic. 1 second, 1 second. So my voice was less audible and none of you told me. I actually missed it to attach the mic. I think now it will be clear. Better? Is there a difference in the voice or the same? So what I was saying, please be back, everyone. If this is deviation at squared level, we needed to find out the average deviation, which is why we divided with this number with 3. So understanding is clear, but writing down the formula in the exam is really important. So what do? Sir, we do sum up the deviation. So if this is dx, which is my deviation, then summation squaring up will be dx square. Average of field will be summation of dx square divided by n. That is how you do average. Total up the thing divided by the number. So totaling up the thing divided by number, this is called as variance, which is at squared level, the unit of which is percentage square. If this was percentage, the deviation was also percentage, and squaring up will make it percentage square. So averaging up will also continue to remain percentage square. That is how it is. And when you do under root the standard variance, it becomes standard deviation. So if this was variance, the standard deviation is represented as sigma x. This Greek letter is called as sigma, right? So sigma x is the standard deviation, which is standard deviation of security, which is under root of variance. If the variance is 616.67, so the under root of will be 24.83. Now this one is in percentage, right? This is calculating the risk in case of past data. Since the method of averaging is different, the table formation of ex ante data as compared to the ex past data is different. What is the table formation? Please look at me, right? Before I proceed ahead, please give me 2 more minutes, please. Yes, everyone. So we are back. Okay. Sorry for the delay. Just give me a sec. So I think this is a better video. Yeah. Great. So what were we saying? Yes, I was saying that, people in the class, that the way to do the average will change, but the broad concept will continue to remain the same. That deviation, the average deviation at squared level is variance. The same thing you'll have to do even in case of ex-ante data. Sir, let's take the same data, 20, 50, 30% probability, possible return 10, negative 10, 15 and 25. When I do calculate the average, the summation of b into x is 13, which is the average return. Now we're going to do how much is this individual possible return deviating from average. So minus 10 is deviating from minus 30 by, minus 10 is deviating from 30 by 13 by negative 23%. So minus 10 minus 30 negative 23, 15 minus 13 is 225, minus 13 is 12. This is the deviation calling as dx. So how much is dx square? Please look at only dx square. 23 into equal to is 529. 2 into equal to 4, 12 into equal to 144. So this is the deviation at squared level, and that multiplied by probability. Deviation at squared level multiplied by the probability of its occurrence automatically give me the weighted average, which is what I wanted to do for variance. Squared level deviation and that to average, but only the difference is this time you have to do weighted average. So if these are my squared level deviation and the probability of their occurrence is this, so on an average how much is going to be the squared level deviation is this into probability plus this into probability is equal to 151, directly the number of variance. As I said, the average will happen in the table itself. Now let's create the formula. If this was x, this became p into x, right? The average, which is called as x bar. So dx is nothing but x minus x bar. So then I had to square it up to make it p dx square. Now after making it at squared level, I need to average it out. So when I multiply p into dx square, we automatically get the total of it as average, which is summation of this column called as p into dx square, being the formula of variance. Yes, standard deviation is obviously under root of that. Variance is percentage square, standard deviation is percentage as its unit. Everyone in the class, at this point I need your validation. Are you all please able to connect to what is going on? Come on. Super fast. Please tell me, are you able to connect to whatever is going on? What do you all say? So now I will take you to a practical question. Let's solve one basic practical question to get a sense of what we have to do. Keep your calculators ready. And I think to be able to solve a practical question, I mean whatever we have learnt so far is so easy that the practical question that I was planning to make you people solve are the same question as we have done in the OutNotes, so there is no point of solving them. To be able to solve the next practical question, we should be able to first do the next concept, which is the return of the portfolio. Yes, what did you all say? Are you all able to connect to what is right now going on? You all are, right? So taking you to the concept of expected return of the portfolio. Sir, if I have invested in different securities, that is my portfolio. In my total portfolio, different securities have different amount of investment, yes, based on which I can calculate the percentage weightage. For example, 1 lakh rupee, 40,000 is invested in security A and 60,000 is invested in security B. Then 40 divided by 1 lakh is 40% and 60 divided by 1 lakh is 60%. Right? That is how the weightages are. Yes, the market value tells you how much is the weightage. Now, sir, what is the use of that weightage? In my overall portfolio, there are different securities. Those different securities will have different expected rate of return. Have we learned already? the expected rate of return of a security? Yes, in the previous topic. So expected return of first security multiplied by the weight of that security in the portfolio. Similarly, expected return of second security multiplied by weight of that security in the portfolio, and similarly for third security, give me the expected return of portfolio. Point of concern is that individual securities expected return we have learned to calculate either the weighted average or the simple average depending upon the type of data. Second, weights are based on market value of investment, the total value of investment in the portfolio. Third, sir, how do you calculate that value, by the way? Sir, that is the market price of every share multiplied by number of share that I hold will give me the overall value of the investment. Sir, next, value of which point, that is the most important time of the beginning of the period. For example, let's say I am calculating the return for the year 0 to 1. For example, for the purpose of weightage, market value will be of this particular point. Similarly, if I am calculating the return for the year 1 to 2, I mean for the second year, for the purpose of weights, market value will be at the end of first year is what I am saying, to whatever number of share you have, right? So market value at the beginning of the period is what you have to consider. Perfect. Now this make you capable of solving a practical question, which is a good question, question number 3. 1, 2 questions were good, but they were so easy that there was no point of doing them. Question number 3 will give you a better understanding of what we are trying to do. So come on. Mr. A, HNI invested on 1,414 in equity share as below X and Y. There were 2 securities in the portfolio. They invested into 1,50,000 share, the cost of which was 2 crore and 1 crore 50 lakhs. In September 14, which means after 6 months, 10% dividend was paid out by X. X, whose face value is 100. Please remember, dividend is as a percentage of face value. So X, whose face value is 100, 10% of 100 was paid out, and in October 30% of 10 for share Y was paid out. Fine. The information regarding the opening investment, the dividend during the year, and on 31st March 15 the prices are 220 and 290. Let me see if I can find out in the handwritten solution, in the handwritten notes, the solution to this question. So portfolio management. This is mutual fund, before that would be portfolio management. Wait. Fixed income securities. Wow. This is the timeline, which makes the entire question discussion really easy. Sir, at 0 point we have been given the total value of investment and the number of share, giving me price per share as 200 and 300. These are the 2 shares with this number of share. The dividend being announced is 10 and 3 for respective year, where the price for year end 2015 is 220 and 290. That's what we have learned. Now, on 1415, technical analysts indicate as follow. Right. Sir, if you observe the language of the question, it is about the past. 10% dividend paid, 30% dividend paid, market quotation showed a value. At this point when I stand, all this is about the past. Now if you language observe, now whatever we do is about the future. For example, technical analyst indicated dividend from the company for the next year are going to be 16.5 and 26.5. I've modified the question to make it easy, and the modified question is the original question. Don't worry about manipulating a question. After modification, whatever question remains is the original question that institute has in its study material actually. Fine. So 16.5 and 26.5 I'm expecting as dividend, and probability of market quotations are shown below. That for the year 31st March 16, which means for the next year, how much are going to be the prices? Sir, 220, 250 and 280 will be the prices, has 20, 50 and 30% chance. Similarly, another security will have this prices has this percent chance. So on the timeline, the entire question, the data given in the entire question remains summarized. What do we need to find out? Analyze the average return for the year ended 31st March 15 return of the portfolio I want. Analyze the expected return for the year 15-16. Did you observe the difference in the word? In the first case, institute asked you the average return. In the next case, institute asked you the expected return. The first return is the actual return. The first return is the actual return of past. Logic of calculation will remain the same, but actual means what has already happened. Expected is what I am expecting it will happen. It is about the future. Yes, what do I need to do? Can I say to be able to calculate the return of the portfolio, I should have the return of individual security? Sir, in the past, return of security X and Y, I can calculate. I can calculate the weightages. Do you agree that for this period, the weightages will be opening of that period weightages? So I can also calculate the weightages and then calculate the weighted average return of the portfolio super fast. Sir, 220 minus 200 plus 10 divided by 200 give me 15% return. Similarly, 290 minus 300 plus 3 give me negative 2.33% return. Individual shares return there. What are their weights? Sir, if you observe 2 crore out of 3.5 and 1.5 crore out of 3.5 give me the weightages as 57.14 and 42.86. Agreed? Then what do you do? Sir, weighted average. 15% will be the return of 57.14% of the portfolio and negative 2.33% will be the return for 42.86% of the portfolio. Yes, 15 multiplied by 57.14% negative 2.33 multiplied by 42.86% and the weighted average is 7.57. Do we have to write down the formulas also? Yes, that is the average return of the portfolio. Sir, next part of the question, expected return for the next year, which means to be able to calculate the return of the portfolio for the next year, we should be able to first calculate the individual securities expected return. 220, 250, 280 are the possible prices. With P0 being this, what are the possible returns? So 220 minus 220 plus 16.5 divided by 220. Give me 7.5% return if you observe. Similarly, the second one, let's calculate. 250 minus 220 plus 16.5 divided by 220. Give me 21% return. 21.13636. So 21.14. Third one is 34.77. These are the possible returns that I can have with this probability. When I do average out, the expected return is 22.7. P into X summation is 22.5. Sorry. How much are these possible returns deviate from 22.5? When you calculate dx, 7.5 minus 22.5 to 21.14 minus 22.5 and 34.77 minus 22.5 give you dx. Then I need to do the square. On calculator, how do you do? Whatever is the number into equal to. Into equal to, make it square into 0.2 is this particular number. Sir, whatever is this deviation, into equal to into 0.5 is this particular number. Sir, this deviation into equal to into 0.3 is this particular number. When I add up all this, I automatically get variance. So sir, this is P into X as your X bar, deviation dx is X minus X bar, and P into dx square automatically is the final variance that I need. Right? But sir, why are you calculating variance? They have not asked for the variance. They have asked for the individual securities return. Because in the third part of the question, when you will read, they have asked in part 3, risk of to investment. Since I have to anyways calculate risk in the third part, so why don't I create a complete table which can give me return and an extension of that risk as well. For risk, you anyways need return, right? Risk is the deviation of returns. So you anyways need return for the purpose of risk. Yes. So bringing you back. Sir, anyways, we have the possible return as 22.5. Similarly, for the second security, 290 minus 290 plus 26.5 divided by 290 give me 9.14 as the return. Similarly, 16.03 and 22.93. These are going to be the possible returns with this probability. The expected return is 16.72. Do you agree? Sir, how much are my returns deviating from the average is dy. If this is y, the average is y bar, which is nothing but p into y. Now I need to calculate dy. How much are these individual possible return deviate from the average is dy. And a square of individual deviations multiplied with the probability when you do, you get these three numbers and automatically the total of it is 23.3, which is the average deviation at squared level. So p into dy square is the formula. I mean is the heading of this particular column. The summation of it is summation of p into dy square is the variance. Anyways, I need the expected return of security B, another security, which is summation p into y 16.72. So I have the individual securities expected return with me. Right? Now, Shakti, I'll respond to your question. Just give me a minute. Sir, next, I need to calculate the weights. Point of learning that when I calculate the return for this period, the market value at the opening time should be considered for the purpose of weightages. So 220 multiplied by 1 lakh and 290 multiplied by 50,000 share give me the market value of investment as 2 crore 20 lakhs. And 1 crore 45 lakhs. Fine. When you convert them to percentage weightage, it is 60.27 and 39.73% weight. And now you can calculate weighted average. That 22.5% return has been generated by 60.27% of the portfolio and 16.72 return has been generated by 39.73% of the portfolio. When you do that weighted average, you get the expected return of the portfolio as 20.20%. Shakti, I'm expecting today's lecture to go for around, I guess, 5 hours, 4 to 5 hours. This is my guess, okay? So that is how, and in that your entire portfolio gets covered. This is my expectation as of now. Sir, what did we learn? Sir, we have learned that using the data of individual security, we can first calculate individual securities expected return, and using individual securities expected return along with the weights, we can calculate portfolio's expected return. Question number 3, with that clarity gets done. Sir, what about the risk? The third part is really easy. Risk is a standard deviation. When they say risk, it is a standard deviation, and under root of a standard deviation, under root of variance, when you do, you get a standard deviation. First variance is 91.09, second securities variance is 23.30. Formula of variance, summation of p into dx square, summation of p into dy square, as we have already learnt, right? Doing an under root of that will automatically give you the standard deviation of respective security, which is what it is. People, I need this validation from your side. Could I very clearly explain what question number 3 was? Could I make you people link the concept with the question? Please tell me so that I can take you all ahead. We can proceed ahead with this. Yes, was it all sorted? Was it worth? So come on, people in the class. Who else in this live class we have? Come on, tell me. Return of the portfolio we have sorted, right? Now taking you ahead to understand the risk of the portfolio. Boss, return of the portfolio seems weighted average, is weighted average, not seems weighted average. Risk of the portfolio seems weighted average, but it is not. It is rather something beyond weighted average, for which we need to understand something called as correlation. Sir, what do you want to say? Let me explain. Sir, if return of the portfolio is return of security A into weight of security A plus expected return of security B into weight of security B. With this thought process, if you observe, what should be the risk of the security? I mean the standard deviation, sorry, what should be the standard deviation of the portfolio? A standard deviation of first security into the weight of first security, standard deviation of second security into the weight of second security. Yes. Perfect. But the actual formula is beyond it. Let me crack it for you. How does the actual formula look like? A standard deviation portfolio, right? Initially to start with seems like the standard deviation of individual security. But can I say to convert it to the variance, I can square up both LHS and RHS. So LHS is squared up, RHS is squared up. If you observe, if I assume this entire terminology as A and this entire terminology is B, can I say the overall formula looks like A plus B square? What is the extension of it? A square plus B square plus 2AB, right? So that becomes the formula, standard deviation of A weight of A whole square plus standard deviation of B weight of B whole square plus 2 into standard deviation of A weight of A, standard deviation of B weight of B, plus the last thing which is new for you to learn is the correlation between securities AB. Now let me tell you, which means to be able to calculate the standard deviation of portfolio, we need the standard deviation of individual security. Yes. We need the weightages of that security in the portfolio. Yes. Which is obvious. Along with that, one more thing you need is the correlation between the security. Sir, individual security risk and weightages are clear. SD weightage is clear. What about the correlation? That is what I'm trying to teach you now. Before learning correlation, I was trying to set the background of how does the correlation, like where is the correlation being used. So, correlation is co-movement between the security. If there are two securities in the portfolio, one security go up, another go up, positive correlation. One go down, another go down, positive correlation. Same direction is positive correlation. Opposite direction, one security return go up, another go down. First go down, second go up. This kind of correlation, if it is there, then this is everyone in the class negative correlation, right? Correlation is an understanding of co-movement. It is measured with something called as coefficient of correlation, also called as correlation coefficient, right? The measurement of correlation is through its coefficient. However, casually we end up saying as coefficient between the two securities 0.8, but actually we mean to say correlation coefficient between the two securities 0.8. It is represented with this terminology R between the security AB, or it is Greek letter rho which looks like P, rho between securities AB. This is how you represent correlation, right? One more, acha, sir, can we also, I mean this denomination which have been marked in blue color, are these official ones? This is how we can denote it, like denote different terminologies in the exam. Yes, these are official. Institute uses it and you can also, and you must also use it. Similarly, something I missed to told you is the expected return of the portfolio. Just like you have expected return of security, ERP is expected return of the portfolio. Bringing you back to the correlation. Sir, how do we calculate this correlation? This correlation is calculated using something called as covariance, and the logic of covariance we will first discuss, then we will learn to calculate correlation, and then we will proceed ahead with further things. So let's learn calculation of correlation first using ex post data, then using ex ante data. Let me tell you, the OutNotes that you are referring to are really very comprehensive. Yes. So people in the class taking your ahead, please listen to me. Ex post data, covariance, correlation. Sir, this time I have been given the possible returns of two security. If you are lucky, you would be directly given the possible returns of past years. However, if you are unlucky, then you will be given the past prices and dividend using which you will have to calculate the past possible returns of both the securities. Could I convey what I said? Using P1 minus P0 plus D divided by P0 using the formula of possible return, you will have to calculate the. You will have to calculate the. Please, everyone. Possible returns, which will then be averaged out and whatever things to be done. So I have possible returns of security XY and years. Examiner will give me this data. Please observe the presentation we will have to do. Sir, if this is X, then I can calculate X bar. Yes sir, 15, 10 at new data. Data changed, 15, 10 at total is 33. Summation of X is 33 divided by N, give me 11, X bar. So dx is X minus X bar. So 15 minus 11, 10 minus 11, 8 minus 11 is this. And what is the squared level deviation? 1619. So total is 26. So the average deviation is 26 by 3, which is 8.67 square, which is summation dx square divided by N is my variance. So first column is year. Then you have 3 column for security X. Then you have 3 column for security Y. And then the last column is common for both the security. So the first column is common for both the securities, last one is common. So 1331 is the format to create the table 1331. Yes. Sir, similarly for security Y, 9, 14, 25 total give me 48. The average return is 48 by 3 as 16, which is summation of Y divided by N. These individual possible return deviate from 16 with these minus 7 minus 2 and by 9, calling it to be dx. So dx square is 49, 4 and 81, the total of which is 134. The average of which is 134 divided by 3 is 44.67. In terms of formula, if it is dx square, the average will be summation of dx square divided by n is 44.67 square. We have not learnt anything new so far. Individual securities, SD and variance, you anyways know how to calculate. This was nothing new so far. Now I am going to teach you first to calculate covariance. Sir, SD is also fine. SD is also fine. Look at the covariance calculation. Sir, when dx, which is securities age deviation, is squared up, is basically multiplied with its own deviation, it is dx square ultimately used in calculation of variance. So when deviation of first security gets multiplied in itself, it gives you variance. First security deviation is square, which is when it gets multiplied with itself, then it is variance. Then deviation of one security when gets multiplied with the deviation of another security is covariance. Deviation of first security multiplied by the deviation of another security automatically give me covariance. In the first year, first deviation, like the deviation is 4, another deviation is minus 7, multiplication is minus 27. So minus 27 is the co-deviation. Similarly, the co-deviation here is 2, similarly the co-deviation here is 27. So these are individual possible years co-deviation. So on an average, how much is the co-deviation? So total of it is 53 divided by 3 give me 17.67 percentage square negative as my co-deviation. Why percentage square? Because you have multiplied the two deviations, making it percentage square. First, second, sir, formula. If this is dx, this is dy, the multiplication of 2 will be dx into dy. The average of it will be summation of dx dy, which is 53. Summation of dx dy divided by n is the formula of covariance, which is here. Yes. Once you have the covariance, now I am trying to teach you the formula of correlation. Correlation, people in the class, is what? I am simultaneously trying to give you the rhythm or the flow behind the thing. For example, when I taught you SD, I made you people realize average deviation from the expected return. Individuals possible returns deviation from the average. Similarly, the co-deviation is also connectable. My deviation with your deviation is co-deviation. Now, correlation actually is a statistical thing where you try to convert that covariance into a relative number. 17.67 is the absolute co-deviation. When you divide that covariance, I am calling that covariance as co-deviation for our understanding. Officially it is covariance. So when you divide that covariance with individual standard deviation, like this is the co-deviation I know. divided by individual standard deviation is 2.94 and 6.68. Give me correlation. This is converting an absolute number to a relative number. Like, for example, when I tell you secured 59 marks in AFM, it is an absolute number. We don't know how much it is. Is it 59 out of 200, 59 out of 60, or 59 out of 100? We don't know. Sir, when I say you secured 59% in AFM, it is clear to everyone that 59% is, even if it is 200, then 59% is the same, understanding. Are you getting? Converting something to relative terms. Similarly, covariance is absolute. When you divide that with the standard deviation, it becomes relative. It gets an interpretation. Sir, what interpretation? Let me tell you. So 17.67 negative divided by the 2 standard deviation give me negative of 0.900 as my correlation between security AB. Learning number 1, can covariance be negative? Yes. So can correlation be negative? Yes. Learning number 2, covariance similar to variance. The unit of covariance is percentage square, but the correlations unit is nothing. It is just a relative measure of correlation. It measures the strength of co-movement. Sir, once the correlation is ready with me, can I calculate the risk? Let's try it on the calculator once. Sir, variance of the portfolio is a square plus b square plus 2ab into r. What is a square? A standard deviation of a, let's say the weight is 75%. So 2.94 multiplied by 0.75 whole square. A standard deviation of b, weight of b, which is 0.25 whole square. 2 into SD of a, weight of a. SD of b, weight of b, multiplied with the correlation being in negative 0.9 between the 2 securities will give me the overall variance of the portfolio, right? So let's super quick do your calculator, get the answer ready. We will then continue to discuss. Just give me a minute. Let me have water for that in the meantime. Yes. Is the answer ready? Have you done the calculation? Sir, how do you do it directly on the calculator? Really easy. 2.94 multiplied by 0.75 into equal to m plus 6.68 multiplied by 0.25 into equal to m plus 2 into 2.94 multiplied by 0.75 multiplied by 6.68 multiplied by 0.25 multiplied by 0.9 negative m plus. Memory recollect, right, is the answer of 1 point something something, under root of which is 1.01% on a rounded off basis as the standard deviation of the portfolio. So using the formula of a plus b whole square, you do the variance of the portfolio, under root of which is the standard deviation. Yes. So in case of exposed data, ultimately you realize that when it comes to the risk of overall portfolio, you just not only need individual securities risk. Individual security risk is fine. There is one more thing that you need, which is the between the two security, how is the correlation? The co-movement how it is, and that eighth column also you need to make. And with that eighth column you first calculate covariance, then correlation, and using the formula of a plus b whole square you calculate risk. That is how the risk of the portfolio in case of exposed data is calculated, right? I hope I am able to convey the every single formula or column or the calculation with clarity. The next is, sir, using ex ante data, how do we do it? The logic is same, just that the way to prepare the table is different, because here in the table itself the averaging happens. So the format changes to 1 plus 4 plus 4 plus 1. It's not 1331, now it is 1441. 1 is the column of probability which examiner gave. Then in the 4 column we will talk about the first possible return x, next 4 column we will talk about another possible return y, and the last one is again for the covariance. Fine. If individual possible return is 10, 16, 20, px the average return is 16. Then individual possible returns deviation from 16 is this. So at a squared level with the effect of probability the average deviation is 12. Can anyone in the class tell me what is this 12 called as? Average deviation at squared level is called as what? Variance. Sir, in the table itself directly you get variance because the table does the averaging at its own. Sir, 12 is the variance, summation of p into dx square. Average deviation at squared level. This is a square. And p gives you the effect of averaging, 12 is the variance. Similarly, for another security when we calculate variance, it is 4, which is fine. Now trying to teach you the next thing. My deviation with my deviation when gets multiplied with my deviation, it is variance. So my deviation when gets multiplied with another security's deviation, it is covariance. Are you able to connect the flow? So minus 6 multiplied by 2 gives me minus 12. But what is the probability of this minus 12 co-deviation? It is 20%. So 12 multiplied by 20% is negative 2.4. So dx into dy is the co-deviation. But the averaging has to happen in the table itself. So p into dx into dy will be the column. Right? So 1 plus 4 plus 4 plus 1, p into dx into dy. So similarly, 0 is 0 only, minus 3 multiplied by 4 is 12, 12 into 30% is negative 3.6, so minus 6, directly you get covariance in the table itself. So summation of p into dx into dy is covariance that we wanted to calculate. Sir, the covariance formula differed because of the type of averaging, but the covariance formula continued to remain same. Correlation formula continued to remain same, which is covariance divided by SD and SD. The table formation in the two type of data is different. Once the table is formed, sir, you get the final. Once the table is formed, the final people in the class formula to calculate after the table remains same. So correlation is covariance divided by SD into SD, minus 6 is the covariance, 3.46 and 2 are the SDs, and minus 8.867 is the correlation. You apply the same formula again, a square b square 2ab into r give you the risk, under root of which is the standard deviation, which is also called risk. Variance is also risk, SD is also risk. If examiner asks you risk, calculate either both or at least calculate SD, don't stop at variance. If they are not clear and ask you risk, they ask SD, fine. They ask variance, fine. In case of risk, do both or at least do SD. That was calculating, in case of ex ante data, the risk of the portfolio. Done. I hope the formula, the table creation and everything you people are clear with. I would request all the, not the live viewers, but the recorded viewers to pause this video. Pause this video, go to your rough notebook or anywhere in the notebook, draw the columns of this 8 columnar and 10 columnar table. Draw the columns. At least 2-3 times you do it so that you get a sense of how exactly the format of it will be. Even if you understand with great clarity, practice altogether takes your preparation to the next level. Right? Everyone understanding? Do you understand something called as muscle memory? Something which is ingrained in your muscles. Similarly, I want to create your muscle memory for The table formation, that whenever you look at a practical question of portfolio management, once you have the clarity that I need to calculate the correlation or covariance, you end up creating the tables immediately, is what my expectations are. So now we need to learn a lot of more things regarding correlation covariance. As we learned, correlation and covariance can be both positive and negative, correct? Covariance is not interpretable, but correlation is. So let's learn to interpret correlation. Sir, correlation can be positive, negative, both. Positive is same direction, both security up, both security down. Negative is in opposite direction, one security up, second down, second up, fine. Sir, about the number. Number tells you the strength or degree of correlation. 1 is a strong, 0 is weak. So when the securities relation is 1, whether it is positive or negative, positive, negative is only about the direction, but plus 1 tells you the perfect correlation. Plus 1 is perfect positive correlation. Let me show that to you here. Plus 1 is perfect positive correlation. Negative 1 is also a very strong correlation. It is a perfectly negative correlation. 0 is the weakest form of correlation, right? So let me write down here weak, strong and strong, right? Positive 1 same direction, negative 1 opposite direction. Sir, between them also we can have correlation, which is a moderate kind of correlation. Sir, an MCQ question really quick. Which correlation do you want to be there between the two securities, the plus 1 or negative 1? Sir, that is the benefit of graphical presentation. This is red color. You never like it, it is danger. This is green color, always good to see, right? So minus 1 is the preferable correlation. You can apply common sense also. Sir, please imagine in this table where you multiply R, or in this formula, if R will be plus 1, the final risk of the portfolio will be more. If R will be minus 1, the final answer of risk of the portfolio will be less. We want the risk to be less, which is why we want the R to be negative 1, the best scenario, right? So negative 1 is better in fact than 0. No correlation, make it 0. Entire terminology becomes 0. But negative 1 correlation give you some number, and that too negative, overall getting deducted from the first two terminologies, first two numbers, right? So now we are clear with risk of the portfolio, understanding and calculation of correlation. Sir, if there are 3 securities, which can be the case in the exam, A plus B plus C whole square, A square plus B square plus C square, multiplied by 2AB into correlation between them, in plus 2BC into correlation between them, and 2CA into correlation between them. Sir, what is the formula? This is A, this is B. So 2 into SD of A, weight of A, SD of B, weight of B into correlation AB. This is B, this is C. So 2 into SD of B, weight of B, SD of C, weight of C, and correlation between BC. And similarly for security CA, this become the risk variance of the portfolio with 3 security, under root of which is variance, under root of which is SD. Fine. So what we have learned? We have learned the risk of the portfolio creating those 8 or 10 columnar tables, right? Trying to teach you one more thing. Please listen to me. You have learned the formula of SD of A, weight of A, SD of B, weight of B, then 2 into A into B into correlation between security AB. Yes, sir. We just read this formula. Sir, what is the formula of correlation? It is covariance between the security divided by SD and SD. Agreed. If you take the SDs here, what is the revised formula? Correlation between security AB multiplied by SD of A multiplied by SD of B is the covariance between security AB. So this SD of A, SD of B and the correlation between security AB. Can these 3 terminologies be replaced with the covariance AB? If yes, the answer is really simple. A square plus B square, which is SD of A, weight of A whole square, SD of B, weight of B whole square, plus 2 into weight of A, weight of B into covariance AB between the securities directly you can calculate, boss. 1 second. Covariance between the securities AB you can calculate directly is what I'm trying to tell you. Are you understanding, people? When I have covariance, there is no need to calculate correlation. I can directly use this covariance formula, right? Sir, this is to be used when institute give you covariance. If they ask you the question right from the scratch, then calculate correlation, use the correlation formula, that's preferable. Because answer has to be same, but due to rounding off sometimes it may differ. That is the another thing I wanted to teach. Similarly for 3 security, same logic, 2AB, 2BC, 2CA will change. Correlation, this interpretation I have explained, this is also fine. And now the units and everything is fine, but before that let us solve a practical question. The next question which can be of great help to us is question number 7, right? Keep your calculators ready. Let's proceed to solve question number 7 right now in the class, super fast, please. Just give me a minute, just give me a minute. Come on, shall we all proceed? There are we all. So let's start to read the question, all the live people, please pay attention. Show me some energies, recorded people, keep your calculators ready, let's proceed to solve it. Sir, question 4 by the institute has a small ambiguity, we'll discuss that as well. The return of security L and K for the last 5 years are given below. In the last 5 years, the two securities has generated these possible return, security L and security K. We need to calculate covariance, correlation coefficient and risk and the return of the portfolio. Return of the portfolio and risk of the portfolio is what we ultimately need. For return of the portfolio, we need individual securities. See, I'm trying to first plan the question with you. I could have started to solve it directly, but planning gives you a sense of how do you think, how should you think for a question. Return of a portfolio need individual securities expected return and their weights. Risk of the portfolio need individual securities risk and weights. Along with that, it needs correlation. So when I create that 10 column in a table, it will automatically have individual securities return, it will automatically have individual securities standard deviation, and it will also have correlation. Weightages I need to calculate separately, everything else is there in that 8 or 10 column in a table. Do you all agree to what I said? People, sir, it is also asking for correlation and covariance, which will automatically gets calculated with correlation. Boss, could you connect to what I said? Sir, first ambiguity, the weights in the questions are missing. We have assumed them 50-50%. First thing. Second, sir, that 8 column table in exposed data is like year, then 3 column for security L, then 3 column for security K, and then a common column. So x dx square, y dy square, and dx into dy. Individual years given. Sir, let's do it on the calculator. 10 plus 4 plus 5 plus 11 plus 15 is 45. Divided by 5 give me 9. How much are these possible returns deviating by 9? 10 minus 9 is 1, 4 minus 9 is minus 5, 5 minus 9 is minus 4, 11 minus 9 is 2, and 15 minus 9 is 6. How much are these returns at its deviation? How much are these deviation at squared level? 1, 5 into 5 is 25, then 4 into 4 is 16, 2 square is 4 and 6 square is 36. The total deviation is 82. Which means this column is nothing but summation of dx square. So average of it will be 82 divided by 5 giving me 16.4 as my variance, under root of which will be 44.05 as my standard deviation. Cool. Similarly, for another security, sir, 11 minus 6, 13, 6, 14. If you total them at 40. If you look at the individual deviations, these are the deviations. The squared level deviation of which is 36, the total of which is 266, and when you average it out, it is 266. 266 divided by 5 is 53.2, under root of which, so variance is 53.2, under root of which is 7.29 as my standard deviation. Are you all agreeing to it? Under root of which is a standard deviation, that is also, sir, fine. Cool. Taking you ahead. So now please look at this. Sir, my deviation, when gets multiplied with my deviation, it was variance, right? When my deviation gets multiplied with another security's deviation, it is co-deviation or covariance. So 3 into 1 is 3, minus 5 into 14 is 70, minus 4 into 5 is minus 20. Let me tell you one particular extremely important thing related to portfolio. Irrespective of how well you understand it, irrespective of the fact you understand with its logics and everything, if you don't do this chapter more and more with the written practice, then in the exam you may lose this question. Why? In the question, it's not more about logics, it is more about the execution. When it is a question of intellect, your thinking capabilities help, but when it is the question of execution, your writing practice helps. This, if you understand, you have understood what you need to do for portfolio management. Having said that, let's bring back our discussion. Sir, dx into dy gives me the co-deviation. So dx into dy, the total of which is 89. So average co-deviation is 89 divided by 5 is 17.8 as my covariance. Covariance is clear. So now correlation. So covariance 17.8 divided by SD and SD. So 17.8 divided by 4.05 divided by 7.29 is 0.603 as the correlation. 0.603 as the correlation. Right? Sir, second thing also gets done. Risk and return of the portfolio. Sir, individual securities return I have, and the weights I have 9 into 50% M plus 8 into 50% M plus. Memory recollect is 8.5. Now the risk of the portfolio. Let's learn to do it on the calculator directly. Sir, SD of A into weight of A whole square. SD of B into weight of B whole square. 2 multiplied by SD of A, weight of A, SD of B, weight of B into correlation between the securities. Let's do it on the calc. Sir, 4.05 into 0.5 into equal to M plus. 7.29 into 0.5 into equal to M plus. Then 2 into 4.05 into 0.5 into 7.29 into 0.5 into 0.603 positive M plus. Memory recollect is 26.29 on a rounded off basis. When you under root 5.1272, which is 5.13 is the SD of the portfolio. If I talk about the rounding off rules, returns, risk, which means everything which is in percentage is primarily rounding off till 2. right? Similarly, 3 till 3 digits, the rounding off requirement is for correlation. So if you go to the OutNotes, the link of which I've talked about, in the initial pages you will find the rounding off rules that has the compilation of everything like present value factor, modified duration, Macaulay's duration, correlation, etc. things are rounded off till 3. Then there are certain things rounded off till 4. There are certain things rounded off till 2. That first page has the compilation of all the rounding off rules which you must refer. Question 4th, with great clarity, the needed understanding gets done. Now the next question before we do. Next question is really easy to teach you something. I'm just trying to teach you how lucky can you be in the exam, right? For example, in question number 7, we have been given the security B&D risk, security B&D expected return, and we have been given the correlation. Can you observe what this question has different as compared to the previous question? Can you observe it? I'm just trying to teach you so that when you look at the question in the exam, you are able to figure out the time it will take for you to solve this question and help you to take the decision whether this question is lengthy or not, whether I should choose to do it or not. What is the difference? So difference is really simple. It is everyone. Come on, are you all people there listening to me? Whatever is going on? Come on, live people. Recorded people, are you all able to connect to me? Yes, I mean, is the comfort there with respect to language, with respect to the way I speak, with respect to the speed with which we are learning things, the approach that we follow in the class? Everything, is it all sorted? Come on, tell me. Yes. Hello, boss. So well, the difference in this question as compared to the previous question is that in the previous question we were given possible returns x and y. Using those possible return you created a table, and the output of that table, which is expected return of security A and B, the standard deviation of security A and B, and the correlation between security A and B, the output of that table has been directly given to me in the question here. So what are the possibilities in which examiner may ask you question? One, they directly give you the output of the table. You don't need to create that extended table of possible returns. First. Second, more difficult or more lengthier thing, you have to create a table which you have previously created in the previous question. The third level of lengthiness is institute give you the data of price and dividend of 2 shares. To security. Using price and dividend data, you calculate the possible return, and using possible return, then you calculate these parameters ultimately to needed to calculate expected return of the portfolio and risk of the portfolio. Could you connect to what I said on this particular thing? I need your people in the class validation. Please. On this particular thing, I need your validation. This is something I've already presented in the OutNotes also, but don't want to discuss it now. It's there in the OutNotes. There it is. There are some questions in which the expected return and the risk is already calculated given along with the correlation, that is question number 7 and 9. Then some question where we have given the possible return and then do the calculation ultimately of risk and return, that is also fine. Then there are some question where we are given the data of price dividend using which first calculate possible return, then these final things, and then ultimately calculate risk and return of the portfolio. That is the difference with different questions already mentioned here. Right, this help you decide that when you choose in the exam, you'll have to choose, right, whether this question to be done or not, or in which sequence it is to be done. So in terms of lengthiness, this decide how effortful the question is going to be. Sir, 7th is an easy question. Let's just solve for your comfort once, one particular part. To security risk and returns given, sir, correlation is 0.15. We need to calculate the risk of the portfolio and return of the portfolio if B part, or let's say C part, 75 investment is in B and 25 investment is in D. So 0.75, 0.25, 10, 18, 12, 20 it is. Come on, at your own, right now in the class, please do it. People, come on. Done, basic. So basically you have to apply a simple formula. Weighted average of returns is the return of portfolio. A plus B whole square is the return of the portfolio. This question doesn't deserve to be done in the class. I just wanted to explain the hierarchy of lengthiness. Right? The next thing we all need to do is question number 9, which is a good question. Right? I won't read the question, but I will explain you the question. The question says that you are a portfolio manager. Right now you invest, suppose these are two security, D security and A security. Right now you invest 100% of your amount in security D. Now you want to invest some amount in security A also. Why? Because of higher return. Security D return is 10, security A's return is 15. Risk security D is 16 and security A's return is 30. So it has a higher risk also. The correlation between the two security, you remember I said it is represented with this sign called as rho RHO. So the security coefficient, correlation coefficient, people in the class, of security between the securities is 0.3. They are asking that right now my return is 10 because I invest 100% here. If I want to if I want to increase the return by 0.5%, what percentage of your portfolio should you allocate to economy A or stock A if you want to increase the return by 0.5? Right now my return is 10. I want to make this return as 10.5%, which means I have been given the weighted average return. The weighted average return of the portfolio I have been given. I have rather than being asked that if it is the return of first security and if it is the return of second security, what should be the weightage of security D and security A such that the weighted average return is 10.5, which I want to achieve. Could you understand the question? This reverse calculation question I want to do once in the class and now has been explained. So 10 is the return into its weight plus 15 into return its weight is equal to the weighted average return of 10.5. When I do solve this equation, the weight of D turns out to be 90% and weight of A turns out to be 10%. Meaning to say, if I want to achieve the return of 10.5, I should invest 90% here and 10% here is the first part's question. This is the main part I wanted to do actually. Second part is about the risk. Individual risk there. They say 90 and 10% weights you have calculated. Please calculate the risk of the portfolio. Everyone in the class right now you all should do with me simultaneously. In fact, before me all should do. Sir, 16 into 0.9. 1 second. 16 into 0.9. 16 multiplied by 0.9 into equal to m plus 30 multiplied by 0.1 into equal to m plus, then 2 into 16 into 0.9 into 30 into 0.1 into correlation is 0.3 m plus, memory recollect is 242.28, right? The under root of which is 15.5653, which is 15.57 is the standard deviation. That is what they have asked. Done. C part of this question you will be able to do only after you have learned something called as Sharpe ratio. They are saying how much will the fund be compensated for the risk undertaken due to inclusion of stock of economy A. Sir, when you include the stock of economy A, you take extra risk. What was the compensation? Sir, how do we calculate it? Examiner is not clear, which is why you will have to kind of remember that you need to use Sharpe ratio here, especially because the risk-free rate has been given. What is the formula of Sharpe? The formula is really simple: return of a portfolio or security minus the risk-free rate divided by its risk. So earlier I could earn 10 minus the risk-free rate of 3, matlab I could earn 7 by taking a risk of 16. Now I am able to earn 10.5, but for that the risk is 15.57. So 10.5 minus 3 is 15.57 gives me the Sharpe ratio. So we will say that the Sharpe ratio has increased from this to this due to inclusion of stock of economy A, right? That is question number 9th gets done. The next question you will be able to do after we have learnt the next concept. So now what are you clear with? you everyone in the class is really clear with risk of a security, return of a security in ex post and ex ante both. You're clear with risk of the portfolio, return of the portfolio again in both the scenario ex ante and ex post data. Risk of the portfolio are clear with both the ways, using correlation formula and directly using covariance formula you are clear with. You are clear with the interpretation of correlation and covariance, and now I'm trying to teach you something very important, not being specifically asked in the question, but as a part of, can be a part of various question, right? So Realme pad is someone asking for IRRM lecture. Let's keep the IRRM lecture tomorrow. Tomorrow morning will be IRRM lecture. Okay? Cool? Done. Fine. So sir, now you please look at this. Sir, standard deviation. See, return is in percentage terms. So the average of a standard deviation is nothing but the average deviation. That is also in percentage terms. Return standard deviation is percentage. But variance covariance is percentage square. Sir, do you agree 15% return can also be, written down as 0.15? Similarly, the standard deviation of 15% can also be written down as 0.15. So, percentage to decimal can be converted by dividing it with 100, and again back to percentage it can be by multiplying it with 100. Next, sir, variance covariance, right? If it is percentage square, if it is needed to be converted to decimals, or if the examiner give you decimal and you need to convert it to percentage, if in case, then it's not dividing and multiplying with 100, rather 100 is square, which is 10,000 you need to do, is the first important thing. So if 252 is the variance, under root in decimal term it is not 2.52, it is 0.0252 is what you have to understand. First thing. Second. Sir, risk-free security can also be one of the securities in my portfolio. I can have one security risky, another risk-free. So will the same logics as learnt previously will apply? The logic of standard deviation of the portfolio, return of the portfolio, correlation, yes, exactly same. Please know that return of the risk-free security is the risk-free rate of return that is there, which we use for CAPM. Sir, risk of a risk-free security is 0. Needless to mention, the name itself is risk-free. Correlation of a security with the risk-free security is also 0. Because due to change in the return of any security, the return in the risk-free security does not change, making its correlation 0. This is something you had to understand. Now taking all ahead a step. Sir, do you understand what is a long and short position? We have read it in derivative. When you buy something, position is long. I don't have anything, but I've sold it. The position is short. Right? What is the implication? The implication is whether it is a risk-free security or a risky security like a share or anything. If I have a long position in any security, this is also related to derivative, which I have spoken in the derivatives revision. If I have a long position in any security, its market value is considered positive, its weight is considered positive. If I have a short position in any security, its market value and its weight is considered negative. Really, really important. Right? We are not going to do a practical question, but a simple situation I will talk about just to get an understanding. Sir, next. Borrowing and lending should also be considered as securities. So when you lend to someone, it is equivalent to investing in their bonds. So investing is taking long position, hence lending is considered long position and borrowing is considered short position in the risk-free security or fixed income security. So for example, when I lend, I have 1 lakh rupee, right? When I borrow 30,000 and invest 1,30,000, how does my portfolio look like? My portfolio has two security. 1,30,000 rupee invested in security A. Then I have borrowing. Borrowing is considered short, being negative. The total will continue to remain 1 lakh. So please always remember, individual security can have positive and negative market value depending upon the position. The total of all of them will not be total, it will be net of all of them. It's not 130 plus 30. If one is short, it will be 130 minus 30 as 1 lakh, and the total of your portfolio will always be equal to your own fund which is available with you. I had 1 lakh rupee available with me, the total will be equal to 1 lakh. Right? This was a basic thing I wanted to make you people understand. There is a small easy illustration which you need to do at your own. Right? This illustration, not a specific question has come in the exam, but it might help you to solve other questions where this concept may be sub-used or tested in the subparts. Sorted? Sir, fine. Now I'll take you ahead to learn something called as minimum variance portfolio. For the very first time now, you will have a formula behind which I will not give you any explanation or derivation. This is the first formula you will have to remember as it is, because the derivation is mathematical. Right? Minimum variance portfolio of two security. Listen to me what is happening. If you have two securities A and B, you try to create a portfolio of two securities. Yes, sir. Can I say in my portfolio the combination of two securities can be anything? It can be 10 and 90. It can be 20 and 80. It can be 50 and 50. It can be 60 and 40. It can be anything. Agreed? So with the combination of two securities, you can create the portfolio. Do you agree, when I create all these portfolio, like portfolio 1, 2, 3, 4, all these portfolio, different portfolio will have different returns and different risk. This is return of the portfolio, this is risk of the portfolio, different portfolio will have different risk return. We want to find out in this equation, in this concept, we want to find out that what should be that exact weightages of the portfolio be. It should exact be 51-49 or 78-22, something like this. What should the exact weights be? Such that the risk of the portfolio is least, such that the risk of the portfolio is minimum among all possible portfolio combinations. Among all possible portfolio combination, which is that particular portfolio combination which will give me the least amount of risk. Before showing to you the formula, could I convey to you what this topic is about, everyone in the class? What is the formula? Formula is this concept is about calculating the weightages, calculating the proportion in which you should invest in security A and B to have the least risk. So weight of A in the portfolio is calculated as variance of B minus covariance between the securities AB, divided by variance of A plus variance of B minus 2 covariance AB. This is how the weightages between the two securities are calculated. Once you have the weight of A, 1 minus weight of A is 1 minus is equal to weight of B. That simple equation you need to remember. In fact, I would request you all to pause this video again, write down this equation twice by looking at it, and then twice again by not looking at it. Will take 1 minute, but you'll be able to remember this equation now for a longer period of time just by writing it down 4 times. Yes, as I said, portfolio, even if you understand, is also about execution. I'm trying my best to explain it to you on the charts or timelines wherever possible, with the underlying logic wherever possible. Question 14th is of that type. I have been given the probabilities, I have been given the possible returns of XYZ. I have to calculate the risk and return of individual share. So in portfolio, first read the entire question so that you realize what exactly is needed to be created. Is it the need of that 8 or 10 columnar table or something else? Individual security risk return is fine. Risk return of portfolio they are asking, which means for portfolio I need a correlation covariance. For that I need a 10 columnar table is what I want to tell you, right? So 10 columnar table, probability a common column, 4 column security X, 4 column security Y, then 1 common column you have to do. Security X 12, 14, minus 7 and 28 with the effect of probability, the average return is 12.55. How much are these possible returns deviating from expected gives me dx. And at the squared level along with the probability, the deviations are this. So squared level average deviation is 167.75 called as variance. Is it okay if I not do the calculation again of the same thing which we have already done, but explaining it with every possibility? Y is 16, 10, 28 minus 2. Sir, with the effect of probability, the expected return of security XYZ, so the Y bar is 12.10. This individual possible returns are deviating with Y with this, the square of which with the effect of probability, which means the average deviation at squared level is 126.98, the under root of which is a standard deviation. Individual return on risk is clear. For portfolio risk return, I need to calculate covariance, which is my deviation with your deviation with the effect of probability. So minus 0.5 negative is into 3.9 into 0.2 is this. When you do similarly for all the possible returns, the total up is the average deviation, the weighted average deviation, the weighted average co-deviation. The weighted co deviation, which is covariance, is 144.25. Sir, now I need to calculate correlation, which is co-deviation divided by SD into SD. 144.25 negative divided by 12.95 divided by 11.27 is 0.988 negative as the correlation. Sir, finally, the return and the risk of the portfolio we want. Return is simple. This multiplied by the weightage of 50-50% give me the return as 12.33%. Risk of the portfolio. SD into weight whole square. SD into weight whole square. 2 multiplied by SD of A, weight of A, SD of B, weight of B into correlation of 0.988 negative give you the weighted average return as 1.26. Under root of directly the standard deviation, the weighted average risk, the weighted average risk of the portfolio is 1.26 at SD level. Main part for which we are here in this question is part number C. Let's do it properly. The other two parts we have already done multiple times, like practice and all we have done. The main part is here, right? So people in the class, please listen to me. I hope you understand there's no point of doing the same thing again and again in the revision video at least, which is why we did not do calculator for this particular thing. Rather, we have just seen what is happening. We have gone through the flow or the rhythm of the question, right? Of the solution also. Find out the proportion of each of the above shares. There are two shares A, B, C, X, Y, Z. Of each of the above share, how much is the proportion to formulate minimum risk portfolio? To formulate a portfolio which has the least risk or which has the minimum risk, how much should the proportions be? So we have to calculate weight of security A as variance of security B minus covariance AB divided by variance of A plus variance of B minus 2 into covariance AB. Variance of A is 167, variance of B is 126.98 minus covariance is 144.25 negative divided by first variance 167, then 126 minus 2 into covariance. When you solve this equation, how can we, sir, solve it directly on the calc? Really easy. Sir, this negative become positive. So it's like 126.99 plus 144.25 m plus. The denominator is this multiplied by negative 2, all again become positive. 144.25 into 2 is equal to plus 126.99 plus 167.74. Divide equal to into memory recollect give me 0.46506.4651, which is 46.51% should be the weight of security ABC. And similarly the weight of security B means XYZ is rest of the 53%. That is how you do minimum variance portfolio. Could I explain 14th question with the needed clarity? People, please tell me. The 15th question is an easy question, does not relate to any particular concept in the OutNotes, right? Is a common sense based question. The actual solution of this question, which is there in the study material, is typical. Fortunately, in the attempt of May 23, Institute gave up with the solution to this question, an alternative solution which is way more easier. Although that is incorrect, but is way more easier. We're going to follow the solution which is easier, and that is also by the Institute, given by the Institute in May 23's exam suggested paper, right? So objective is to just go through the question. Please read the question really carefully. Fine. Two portfolios are there in the minimum variance set portfolio. Sir, does it relate to the concept of minimum variance we have done? I mean, the concept it relates, but the formulas and everything is different because we have done the minimum variance of 2 security. This question is regarding the minimum variance of a portfolio having 3 securities. That's how it is different. So portfolio X having these weightages is at minimum variance portfolio. Portfolio Y is also at the minimum variance portfolio. Fine. There are no restriction on short sales, which means you can also take the short position. First question, common sense. What is the weight of each stock constructed by investing 5,000 in portfolio X and 3,000 in portfolio Y? When you invest 5k here and 3k here, you will have to actually invest in different securities. Here also in different securities. So overall, when you look at that 8,000 rupee, what is the weightages of individual security in that 8,000 rupee portfolio is what they are asking. So 5,000 into 30% is 1,500, into 40% is 2,000, into 30% is 1,500. Similarly, 3,000 into 20% is 600, then 1,500, then is 900. So how much is the total? Sir, 1,500 plus 600 is 2,100. Security B total investment is 3,500. Security C's total investment is 2,400. So in my 8,000 rupee portfolio, if I try to back calculate the percentage weightages, it is like 2,100 divided by 8,000 is 26.25%. In the background, you are facing some noise, which I can understand, but unfortunately some construction is going on. I cannot control that thing which is beyond the physical boundary of my house, right? And that is an everyday thing. Construction takes years now, 2 to 3 years at least. So now back. Sir, 3,500 is the total amount of investment in security in the combined way for both the portfolios. Total is 3,500. As a percentage of 8,000, it is actually 43.75%. That is how the first part of the question to be solved, all common sense based. Second part of the question, which is actually illogical but easy, at least way more easier than the original solution of critical line that we have not covered, because an easy way is there. Listen to me. Suppose the investor wants to invest 4,000 out of 8,000 in security A. Youth invest 4,000 here. How much should the investment in B and C be there? How much should the investment in B and C to ensure minimum variance portfolio. Sir, 50% of your investment has already been in security A. How much should the investment in B and C be? Sir, please apply common sense. According to them, if 50% of the investment is there in security A, then in the other two security, the investment should be there in rest of the weightages. For example, security A's total investment can be 26.25%. Then other two securities weightage should be, sir, it should be in the proportion of 0.43 and 0.3. So 4,000 already invested, rest of the 4,000 will be broken down in this ratio. So 4375 divided by 437 plus 30, right, gives you some proportion. 43.75 plus 30 divide equal to into 43.75 gives me 59.32 percentage. So 59.32 percentage of rupee 4,000, right, is 272373, which should be the investment in BB, and rest of 1627 should the investment in security CB. So A is 4,000, these are the other two investments simply broken down into in this proportion, right, is illogical but is the best way to easiest way to solve the question number 15. Boss, could I convey to you all the entire thing? Please tell me. Yes, people? 1 second. Fine. So that's 15th question gets done. This everyone in the class completes the entire section, which is section 1. Right. Next section, everyone, is about Sharpe index model. Sharpe index model, right? So we will take a quick 2-minute break, 3-minute break before we start the next model, where we gonna learn a lot of things, that too in a logical manner. So let's take a quick 2 minutes break, 3 minutes break, then we come back. Alright, just in 2-3 minutes. Bye. Just one second, people, please. Fine. There are we all. So let's get started. So far, people in the class, we have talked about calculating the total risk and the return of individual security as well as portfolio. Now in this section, we're gonna learn that how that risk of a security or how that total risk of a portfolio can be bifurcated into systematic and unsystematic. For that, you need to first of all understand what is systematic and unsystematic. What I say actually is theoretical in nature, but unless I explain that theory to you, you won't be able to connect what do we want to calculate. So super fast, please listen to me. Do you understand risk? When I talk about total risk, it is standard deviation. Fluctuation in the returns. Why does that deviation or fluctuation happens? Because of different news that come up with the market. For example, in the market it comes as a news that government has announced demonetization. The security price will fall. The return will automatically fall. How do you calculate X? The possible return, how do you calculate? P1 minus P0 plus D divided by P0, right? So that possible return depends on the price, and the price depends on various factors in the economy. Those factors can be industry or market level factors, macro in nature. For example, demonetization, inflation issue, GST issue, or any other thing like COVID. Whereas unsystematic, the factors which are macro in level, due to those factors, if there is any risk, that is called as systematic risk. But then there are micro or internal level factors to the company. For example, company any license getting cancelled, companies a particular product getting failed, or anything, right, which is specific to the company. Due to those factors, if there is any risk, that is unsystematic risk. This is sufficient for you to solve the practical question. Please no names, no more names. Systematic risk is also called as unavoidable market or non-diversifiable risk. Unsystematic risk is diversifiable risk, avoidable risk, is specific to the company risk, unique to that company risk, idiosyncratic risk or residual risk or random variance or random error. These are the possible names. You should just know. Fine. Learning to calculate the individual securities systematic risk. Then you will learn individual securities unsystematic. Then you will learn portfolio systematic and then portfolio unsystematic. This is going to be the flow. So everyone in the class, please super fast look at this. Everyone, what happens? Sir, before I go ahead, just a small thing you have to understand. In a single security, there is systematic and unsystematic risk both. As you add more and more security, suppose you make 6 security, 10 security, or you have, for example, 30 security in the portfolio. So as you add more and more security in the portfolio, the systematic risk, which is commonly there in all the securities, will continue to remain even in the portfolio. But unsystematic risk, which is specific to a company, not all the securities, is that unsystematic risk which is specific to a security that is not there to all the securities in my portfolio, that will continue to decline if I add more and more security. What is the logic we learned here? Right? I'm not narrating the logic again, but the conclusion is this. What do you mean to say? Meaning to say, as I add more and more security, conclusion number 1, the systematic risk continue to be there in the portfolio, but the unsystematic risk continue to get eliminated, and it gets significantly eliminated when I add all the securities in my portfolio. Almost eliminated when I add all the securities in the portfolio. Second, as a result of which, when I add more and more security in the portfolio, ideally the total risk in my portfolio should continue to fall. Third and important conclusion, when I have added all the securities in my portfolio, suppose the market has 50 securities, when I add all 50 of them, all 50 securities of them, then after adding all the security, since the unsystematic is significantly eliminated, fully almost eliminated, then my portfolio total risk will have only systematic. My total will be only systematic. So that is what the case with the market is. People, the market which has all the security. If you do any calculation for market, for example, a particular security has return, even the market has return. The particular security has risk, even the market has risk. So when you calculate the risk of the market which has all the security, its total risk that you calculate will be systematic only. There won't be anything unsystematic in it, is what I want to tell you. Sir, what represents market? The Nifty and the Sensex represents market. The index represents market, which means index standard deviation, its total risk is only systematic. Now taking ahead two people for you to understand the systematic risk calculation, which is beta. Beta tells you systematic risk but in relative terms. It tells you the systematic risk of security but relative to the risk of market. If I ask you what are your AFM marks, you can give me two answers. Sir, 59 for example. Sir, why do you take the example of 59 every time you teach us? Just a random number, let me take a better number which should not hurt you, 75 or say 85. If I ask you how much were your AFM marks, you may call it 80. Or you may say, sir, double of the average marks in the market. For example, in the market an average student secured 40. So how much is the double of that? 80. So you can answer it in the absolute terms like 80, or you may answer it in relative term, relative to some other number. So similarly, beta is a risk number, but it tells you the systematic risk of a security, but relative to the risk of the market, that in the market if this is the risk, then how much risk I have? 2 times, 3 times, 4 times, whatever is your beta is the interpretation, right? Taking you ahead, sir, beta is also called as sensitivity of return of security due to return of market. Due to market, how much is the sensitivity of return of the security? Correct? Now, sir, how is beta interpreted? Percentage change in the return of security due to percentage change in return of market. That is how the beta is interpreted. That is also being used even in the derivatives. Sir, next. Similar to correlation, beta can also be positive, negative. Positive is same direction as market, negative is opposite direction as market, right? Degree of beta is whatever number 1, 2, 3, 4 tells you how many times the systematic risk of a security is as compared to the systematic risk of market, or as compared to the total risk of market, since both are same. Fine. Sir, for example, this table can be of help in exam while solving a lot of practical questions. Sir, beta of a security is 2. First, let's try to understand how risky that security is. As compared to the risk of market, the systematic of risk of this as compared to risk of market, the systematic risk of that security is more because it is beta is 2. It is double the risk of market, meaning to say, sir, when market go up by 2%, which means positive 2, and the beta of the security is 2, which automatically means the security should go up by 4%. If market goes down by 3% and beta of the security is 2, then security should go down by 6%. Sir, minus 3 multiplied by 2, when you bring minus 3 here, multiplied by 2 gets you minus 6%. Getting it? Are you all? Please tell me. Yes. So now, come on, please, just a second. That way, everyone in the class, in the entire AFM, there are different possibilities. If I have been given the return of security, change in the return of security, and I have been given the beta, I can calculate the change in return of market. Or I have been given the change in return of market, then with the beta I can calculate the change in return of security. Or I have been given if the two changes, then the beta can be calculated. Sir, this table is an example of all that. When the beta is 1, risk of a security same as market when the beta is 0, which means the security is risk free. Sir, when the beta is less than 1, whether positive or negative is just the matter of direction. If it is less than 1, then the security is risk is less than the security, less than the risk of market. Cool. Now, interpreting the beta and using it, applying it fine. Calculation of beta can happen in two ways. One is correlation method, another is regression method. Both will give you the same answer. The first look easy, but is actually difficult and lengthy. The second one looks difficult, but is actually easy and less lengthy, shorter to do. है ना? Sir, first is correlation method, which says if you want to calculate the beta of any security, that is correlation of that security with the market. Can you please imagine it? Can you please link it? Beta of any security somewhere links security and market. So we need the correlation between security and market. Multiplied by standard deviation of security divided by standard deviation of market. You can also link it. Sir, standard deviation tells you change. So that is the logic. How much is the change in the return of market? Due to the change in return of market, how much is the change in the return of security? But sir, this we are comparing the total change, meaning to say standard deviation tells you the total risk, and in beta we only talk about the systematic risk. So sir, market's total is systematic only. Okay, you can ignore this, but security's total is total. It has both systematic and unsystematic. So in the security, if I need only systematic risk, not the total risk, to find out the systematic risk of a security relative to the systematic risk of market, sir, what do? I multiply it with the correlation of security and market. I have tried to, in my easy words, convey to you the derivation behind this simple formula. Correlation between security and market tells you that in this total risk of a security, how much is linked to, how much is related to market. So that is systematic. But how much is that systematic risk related to the market is its beta. So numerator divided by denominator is beta. I hope I could convey the same formula. As I said, I'll try to make sure you won't have to mug up. Either I'll give you mathematical derivation or intuitive one. I hope this intuitive derivation could get conveyed to you. Now let me take you all ahead. Sir, beta, this which is this formula can be modified into this formula. Sir, how? If you see, the correlations formula is covariance divided by SD into SD. So in place of this thing, let's put this one. So numerator has covariance, but correlation of SD of A gets cancelled with SD of A. SD of M gets multiplied with the SD of M in the denominator gets me variance of market. So covariance between security market divided by variance market become a sub-derived formula of correlation method, if you realize. This one can be followed whether the data is exposed data or ex ante data. Meaning to say, sir, if I need correlation covariance, I need to create that 8 and 10 columnar table. Yes, as we have learned previously, that extended table will have to be created here. I'm not only trying to teach you the concept, the logic behind it, also trying to make you people understand how does the question solving happen. How should the question solving happen? Sir, next is regression method. The formula looks difficult, is actually easy. Sir, through this formula, you know what? Do you see what are these numbers x and y? Sir, the possible returns, meaning to say directly using possible returns I can calculate the beta here, but this method called as regression method can be applied only when the past data, exposed data is given. N is there, right? The number of years is there only in case of exposed data. In case of ex ante, we don't have the number of years, which is why what do? Please listen to me carefully. We say beta of a security is summation xy minus n into x bar y bar divided by summation x square minus n into x bar square. You just look at this formula. Don't do anything. We will solve a practical question, then you write this formula twice in your notebook, then you realize what this formula is. So, fine. Beta of risk-free security is 0, beta is market is 1. Beta can be both positive, negative. Beta can be more than 1, it can be less than 1. It has no restriction. Sir, that's all about calculating the systematic risk of security called as beta, which is a relative number. Could I please convey this entire thing to you with all the clarity I could. Please. Should I take you all to the practical question now, everyone? Please come on. Practical question, question number 17. Are you all ready? Shall we proceed? All the live people, all the recorded people. Come on, tell me. Shall we? Everyone in the class? So. Come on. So. Multiple time asked by the institute, a really basic and good question. Following information available with respect to JK Limited. One more thing before I tell you, before I make you people solve a practical question. So listen to me. Whenever examiner give you a data, where a data of market is also given, the possible returns of market is also given, make it a rule that possible return of market will always be assumed X and possible return of security will always be assumed Y and Z and onwards, but market has to be X. Then only this formula will work, because in the denominator, if you realize, we need a market. In the denominator we need a market. In the denominator we need a market. In the denominator we need a market, which is why in the denominator we have market, which is X. Right? So taking you all ahead, please listen to me. So, information regarding JK is given, the average share price of the last 4 years and the dividend per share given. Wow. When someone gave you the price and dividend data, can you feel that you have to calculate the possible returns? Fine. The market, the index, average index has been given and the dividend yield has been given. This question has a point of learning. The risk-free rate of return you eliminate, because we have eliminated this particular part in this question. Right? Sir, what's going on? Explain. Market data, market's possible return will be considered X. Securities possible return will be considered Y. But sir, how do you calculate market possible return? Do you agree P1 minus P0 plus D divided by P0 can be written as P1 minus P0 plus D1 divided by P0? Agreed? Yes, sir. This part is called as capital gain, this part is called as dividend yield. Sir, DPS divided by MPS, and the basics, if you remember, is the dividend yield, right? DPS divided by MPS is the dividend yield, right? I've talked about this in the equity business valuation chapter, which is securities valuation. I've talked about this in the derivatives as well. Dividend as a percentage of price is dividend yield, which is directly given to me. So I need to calculate capital gain yield and add simply the dividend yield of every year to the capital gain yield to find out the total possible return. Agreed? So 1950 minus 1812 divided by 1812 is 7.62%. Plus 5%. Please understand, for 2012 return calculation is not possible. The first year is 2013. So 12.62 percentage is the 12.62 percentage is the possible return of market of 2013. Similarly, for 142258 minus 1950 divided by 1950 plus 0.06 give me 21.7948. So 21.79. Similarly for third year. So I have the possible return, which is X of 3 years. Similarly, possible return of security we can calculate for 3 years. Let me do it for 2013. 279 minus 242 plus 25 divided by 242 in percentage terms, sorry, is 40, sorry, my bad. 279 minus 242 plus 25 divided by 242 is, why is this number? 279, 242, 25. Why am I getting 49%? Wait. 279 minus 242 plus 25 divided by 242. 25.6198, which is 25.62%, the possible return of 13. Similarly, 14 and 15 we can calculate the possible return. Do you agree this much is all fine? I mean, examiner could have given to you data of this possible return directly, but it thought of taking you a step back. First calculate the possible return they want and then you calculate the beta. Have we been given the past data? Yes. Can the formula of regression directly apply? Yes. Sir, why should we prefer that? Because that's easy. You already have the two columns given in the question. You just need to create two more columns, and even those two columns are easier than the columns of dx, dx square and so on. What are the two columns? If this is x, this is y, the next column is x into y. This into this, this into this, this into this. If this column is x, the further next column is simply x square. That's what you have to do. Sir, 12.62 multiplied by 25.62 is equal to 12.62 multiplied by 25.62 is 323.32. Similarly, the next possible returns multiplication, give me this. If this column is x into y, the total of this will be summation xy. The total of this column will be summation xy. Similarly, if this column is x, next will be x square. 12.62 into equal to is 159.26. 21.79 into equal to is 474.80, and 5.32 into equal to is 28.3 as x square. So automatically the total of this is going to be summation of x square is what I want to tell you. Agreeing? Are you all to it? Agreeing, are you all to it? Yes, people. So we have now two columns given by them, two columns we made ready, and now the formula. Formula is really simple. Summation of xy, which is this number 851, minus n matlab 3 years data, into average of x and average of y, x bar and y bar 13.24 and 20.91. This is numerator. Denominator is really simple. Numerator is the total of xy column, then multiplication of average, and then multiplying it with n. Next is denominator. Wherever in the numerator you have x, make it, whenever in the numerator you have y, make it x. So summation of x into x should be summation of x square, which is why we created the next column as x square. When you add it up, it becomes 662.36 in the denominator. And n into x bar is x bar square. So x bar we can see is 13.24. Square of 13.24 into 3, that if you deduct from 662 become the denominator. Mathematically, how do you solve it is this is another part, but implementing the formula is the part. This is the second formula for which I have not taught you neither intuitive logic, not mathematical derivation. It is just the mug-up you will have to do. It is pure statistics. First was minimum portfolio variance. Second is this, which you'll have to mug up as it is. People in the class, please understand what is going on. What's going on? Sir, according to the formula also you can think which two columns will you need. When you have word summation here, it automatically implies that is a sum of some column. So which means you will have to create that column. One column is xy, another column is x square, which is an extremely easy calculation that if you get the total of, you can directly put these numbers in the formula. So as compared to creating that 8 columnar table, right, in which you have to calculate dx, dy, then correlation, covariance, and then do beta. Here, using directly the possible returns, you can calculate beta, which looks less effortless if you remember the formula. Yes. So now pause the video, recorded people, live when you cannot. Pause the video, right, and write this formula twice by looking at it, and then twice by not looking at it, so that we can have some remembrance of it. I hope I could explain to you the beta calculation in 17th question through this formula, which is the regression formula. Now, do you realize we need to have market always in the denominator? But if the data is x ante, then you will have to compulsorily use this formula. Sir, in conclusion, when examiner give you past data, then only the choice arrives. When the examiner asks you only beta, you do this directly. But if the examiner asks you correlation, covariance, variance, etc. things, then then you are anyways doing correlation, variance, covariance, for which you need that at columnar table. So calculate the beta using this formula only, because then you have to only apply formula, not create any table further. Yes, boss. So concept of this gets over. 17th question is done. 18th, for your ease, for our practice, if we want, we can do. Let's try to do it very quickly. 18th question only for the sake of practice, so that I can have coverage of more and more questions in this revision video, along with zero compromise in the concept. Everyone in the class, look at this. The distribution of security F and market portfolio P has been given. You are required to calculate expected return, covariance, and the ultimately beta. Sir, are you people comfortable with that 10 columnar table? Probability, then 4 columns, then 4 columns, and then 1 column. Sir, why is it not 4 columns and just 3 columns? Because they have used covariance divided by variance formula of market. In this formula, we don't need a standard deviation of the security, which is why the standard deviation of the security, which is P into dy square, has not been calculated. P into dx square, which is the standard deviation of market, has been calculated, which is needed in the denominator. Having said that, you don't need to compulsorily follow this. You can create your standard 10 columnar table and use the data whatever you need below. Correct? For example, 30.4.3 is the thing. Possible return for portfolio, you need to, portfolio P is market. This is the data, this is the data for market assumed as X. 10 minus 20, 30. Possible return is 14. Deviations, the same thing you have to do again and again, not repeating in the class. Deviation of these possible return from X bar is this. A squared level deviation on a weighted average basis is 264, which is variance of market. 30, 20, 0. Possible return 17. Deviation is 13, 3 minus 17, and squared level deviation, deviation is what we have calculated. We have not calculated the variance of the security, which if you want you can calculate. 13 into equal to into 0.3 m plus 3 into equal to into 0.4 m plus minus 17 into equal to, which is dy square into probability 0.3 m plus. Memory recollect will give you the variance of the security directly. That is also fine. Fine. Next, my deviation with your deviation with the effect of probability give you the weighted average co-deviation. So 24 into 13 into 0.3 is negative 93.6. That way, the average co-deviation of all possible returns is 168.0. I need to calculate covariance, done. I need to calculate security beta for the security, which is covariance between security and market divided by variance of market, 0.636 negative. Rather than this, if you do correlation between security and market, for correlation first you have to do covariance divided by SD. So you will have to have the SD of security as well, not only market. Market SD is here, security SD you will need. That you divide, you get correlation. Then same correlation again, SD of market divided by SD of security, when you do, you get 0.636, the same answer for question number 18. Right? I hope you realize the objective was not to do the same calculation again and again on the calculator. The objective is rather give you the flow or the rhythm of the question. Is this objective being met? Boss, is this objective being met? What I want to tell you, what I want to rather ask you, in fact tell you, is that when you do solve the practical question of portfolio management in the notebook, write down the formula, but don't think formula, think the flow. My deviation into your deviation with the effect of probability is this. This is the flow. What is the formula? Dx into dy into p is the formula. Flow, when you think, you are revising the concept. If you realize formula, if you write down, you are just revising the formula, or practicing the formula. Yes, 18th question gets done. 19th onwards you'll be able to do only when the next concept is being taught, which is learning to calculate the unsystematic risk of individual security. In other words, breaking down the total risk of individual security into systematic, unsystematic. Right, first, beta of a security, as I said, is represented like this. Systematic risk, which was beta, you have learned. Unsystematic risk of a security is presented with sigma. When you draw E, it is like an error term, represents unsystematic risk of security A. Similarly, this is unsystematic risk of security B. This is a standard deviation. When you square it, it becomes variance. Correct? Sir, can we use this in the exam? Yes. In fact, be prepared that examiner also sometime use this, and you have to understand what is given. In a particular question, institute give you this. You have to understand that, okay, first of all, it is variance, it is a square level, and that too it is unsystematic because that error term is here. Yes, boss, are you able to please connect? That is what I want to tell you. Sir, unsystematic risk of individual security. Let's look at this. What it says. Sir, if you have the total risk, from the total risk, when you deduct systematic, what you're left is unsystematic, meaning to say, to calculate unsystematic risk of any security, there is no other way. It is always the residual risk which is left, which is why named as residual risk. Total minus systematic is unsystematic, but not at SD level, rather at variance level. From the total variance, when you deduct unsystematic, what you are left with is, when you deduct systematic, what you are left with is unsystematic. For example, variance, the unit of which is in percentage terms. How do I find systematic variance? Sir, systematic risk we have already learned to calculate, which is beta. But that is what was not an absolute number, that is a relative number which tells you the risk relative to market. Overall, how much is the systematic risk? Overall, not in relative terms but in absolute terms, common sense. A standard deviation of the market tells you how much is the total or the systematic risk of market. My beta tells me relative to the risk of market, how many times is my systematic risk. So won't it give you the absolute systematic risk of your security? I'm trying to explain every possible things with great precision if you realize. Market systematic risk is 10%. Market total risk is systematic only, SD is 10. I have 2 times systematic risk than that of market, so isn't my systematic risk being 20? Now since it is at variance level, you have to square it out. That simple is the formula of systematic variance. So from the total variance, which is sigma of a security A at squared level, when you deduct systematic, the balancing figure automatically is unsystematic, for which there is no formula. There is one more formula to calculate systematic, although the preferable one is this only. However, when institute give you the data of something called as coefficient of determination, then you use this formula. This formula, the derivation is here, which I want, let's not talk, right? Or let's talk for a second, because otherwise you'll feel it as a mug up. Sir, because on the class since I've taught you, revising it here in this video will make you connect it more. Sir, can I say the formula of beta is correlation into SD by SD of security in market? So this when I get here, so standard deviation of market into beta of security is equal to risk of a security into correlation. So sir, this entire thing which is here, can it be replaced with this particular thing as standard deviation of security into the correlation between security and market, but at squared level? Yes, fine. Sir, if this is total variance, if this is systematic, from the total if I deduct systematic, what do I get? I get a standard deviation of security at squared level minus a standard deviation at squared level into correlation between the security and market at squared level. Do you know what is this correlation between the security and market at squared level called as? It is called as coefficient of determination. Correlation of a security with the market at a squared level is coefficient of determination. Yes? Sir, when you do calculate the variance, when you do calculate the variance of a security, right? When you take in this equation, when you take common, take out of the bracket variance of a security, what you're left with is 1 minus correlation of correlation square, or 1 minus coefficient of determination. So in conclusion, if you observe the two formulas, what feeling does it give to you? That my total variance is broken down into two parts. One part is coefficient of determination, which is r square. Another part is 1 minus coefficient of determination, which is 1 minus r square. It is like weightages, 1 minus w and 1 minus w. What is that weight? That weight is r square, coefficient of determination. So r, which is correlation between security and market, coefficient of determination, sir, tells you the proportion or the weightage of total variance that is systematic, also called as that is explained by the market. This formula or this formula will give you the same answer of systematic and unsystematic variance. Which one is preferable? This one. If the examiner give you the data of coefficient of determination directly, then you will have to use this formula. Otherwise, the above formulas are sufficient. Yes, boss. Sir, systematic and unsystematic variance, once you calculate the under root of that will be, sir, systematic and unsystematic standard deviation. That is how at security level you do this breakup. Fine. Sir, institute has the practical question of this, but in the later part of the chapter, not a specific question, which is why I created question number 9 only for your ease and comfort. It's not institute's question. Sir, now just like you broke down the security, let's learn to break it down at portfolio level, right? Trying to teach you the systematic risk of portfolio first, then unsystematic risk of the portfolio. Systematic risk of the portfolio, extremely easy. Beta of the portfolio is what? Beta of first security into its market value. Beta of second security into the market value divided by sum of market value. Basically, the weighted average we have to do when the weights are absolute like this. If the weights are relative in percentage terms, beta into weight plus beta into weight and so on. Point to remember, can the beta be both positive, negative? Absolutely yes. Can the market values be both positive, negative, or the weights be both positive, negative? Yes. Long position positive weight, short position negative weight. This is something the reference of which has already been given in the derivatives, and you will need to know it in derivatives because there we use this thing of positive, negative weights according to the position. Yes. So, sir, market value calculation is really important. If in the first security my weight is 10,000, second security short position 3,000, my overall portfolio value is 7,000 and not 13,000 is what you have to know. Please remember, beta of risk-free security 0, beta of market is 1, beta of index is 1. That's all about weighted average. Let's solve a simplest question of weighted average. So easy that it doesn't deserve to be solved in the class. Only for the sake of solving, we are solving it. Super fast, please look at this. You have 5 securities, just trying to explain the question directly, not reading it. You have 5 securities, you have individual beta. Total 3 crore you want to invest in 5 security, part 2 of the question solve. If you invest 15% in S, 0.15 in S, 15% in P, 0.15 in P, 10% in C, 0.10 in C, and balance in the other 2 security. So 15 plus 15 is 30 plus 10, 40, which means 0.3 and 0.3. In the other 2 security, what is the beta of the portfolio? So 1.6 into 0.15 M plus, 1 multiplied by 0.3 M plus, 0.3 negative multiplied by 0.15 M plus, 2 multiplied by 0.3 M plus, and 0.6 multiplied by 0.1 M plus. Memory recollect is 1.155 times as the weighted average beta. Please remember, the calculation of beta is still 3 digits after the decimal point, 0.980 and 1.155 times. Easy, that's how the weighted average happened. Third part of the question has an ambiguity, which is why I want to teach you. Question says RMS 12. rate of return of market is 12. RF is missing and asking me to calculate the expected return. Sir, expected return, required rate of return using CAPM, RF plus beta into RM minus RF. Sir, if the RF is missing, then institute has only done RM into beta, for which I don't have any logic, just that it has done, I have to tell you. RM into RF is what the institute has done. Sir, the security beta into RM is what the institute has done. The securities beta or the portfolio beta is 1.155. RF is 12. When you multiply the two, 13.68 is the portfolio or the portfolio's expected return as per CAPM. It is third part gets done with ambiguity. Fourth part is logical. Fourth part I am explaining. It says the market is expected to have plus 10% return. In that case, if the market is expected to have plus 10% return, then in that case, people in the class, examiner is asking, among all these 5 securities, which 3 securities will you choose? Common sense. Sir, higher beta tells you the higher sensitivity. Market is going up. If you choose positive beta security, security will also go up, and that too with a bigger number, security go up with a higher number, meaning to say first preference, second preference and third preference. So at least 20% you need to invest in each. So let me invest 60 here and the best security 20 in the other 2 security and calculate weighted average beta. That simple? That is fine. Sir, next. If the market return is -5, so if you choose negative security, if the market goes down, the security go up. Negative beta security is only one security we have, so that becomes the best security. The other 2 security has to be positive, but at least a lower positive security, that market goes down, security also go down, but at least at a lower rate. So this is security 2, this is security 3. Which means you invest 60% here and other rest of the 20% in the other 2 security and then calculate weighted average beta. That is about question number 20 being discussed. Could you understand the weighted average? You know how to do, we just did in part number 2. I'm just trying to teach you which 3 securities and in what weightages will they be selected to answer part number 4 in both bullish and bearish phase. Learning to apply this table that we learned for beta calculation, this particular table. Yes, boss? Yes, boss. So weighted average beta of portfolio we are done. Now to be able to solve further questions, we need to understand further concepts. And now collectively 2 concepts before we can come to the next part of the practical questions, which is going to be really great and interesting. Yes, everyone. So let us proceed. Sir, just like, let me try to teach you something. If you understand that easy thing, you'll be able to understand everything. Sir, security A and security B. With the help of 2 securities, I could create a portfolio. Done, sir. Agreed. Sorted. With the help of security A and B, I created a portfolio. Security A, total risk is there. Security B's total risk is there. From the total risk of security A and B respectively, if I deduct their systematic risk. Sir, how do I calculate systematic, boss? This one. How much is the risk of the market? And multiplied by my beta. So risk of the market multiplied by my risk relative to market will give you the my overall absolute term systematic risk. So my total risk minus my systematic risk is my unsystematic risk. Similarly, I have one more security, that another security's total risk minus security's unsystematic risk will give me security's unsystematic risk. Fine. Sir, that same logic that you did for security AB, you can also do it for portfolio. Meaning to say, if you have security A, if you have security B, if you have the total risk of security AB, Using the total risk of security AB, can you calculate the portfolio's total risk? Markowitz model, sir, A plus B whole square formula, the Markowitz model, this is risk of A, this is risk of B. So A plus B whole square, A square plus B square plus 2AB will give you the total risk of the portfolio that we have done in the first section. Yes. Sir, from the total risk of the portfolio, if you somehow deduct the systematic risk of the portfolio, will I get the unsystematic risk of portfolio? Yes, it is the first method. Total risk, total variance of the portfolio that you calculate using Markowitz model minus the systematic variance will give you unsystematic. What is the formula of systematic? The systematic formula is really easy. How much is the risk of the market? And relative to market, how much is the systematic risk of my portfolio will give me my overall absolute term systematic risk, not the relative term. Market risk, for example, is 10%. My beta systematic relative to market is 1.5 times. So my systematic risk is 15%. At variance level, it is 225. At my portfolio variance, systematic variance become 225. Understanding, are you all? From the total, if you deduct systematic, you are left with unsystematic. So the total of portfolio can come from Markowitz. From that, if you deduct systematic, you are left with the unsystematic of portfolio. That is the first thing to calculate unsystematic of portfolio. There is one more method to calculate unsystematic of portfolio. Sir, how? If you have individual securities unsystematic, you calculate it, right? Total minus systematic is unsystematic of individual security. Using the unsystematic of individual security, can I have the unsystematic of the entire portfolio? The answer, everyone in the class, is yes. Unsystematic of the entire portfolio, people in the class, you can calculate how? Sir, simple. Do you remember the formula of A square plus B square plus 2AB? A square plus 2B square plus 2AB, right? Sir, unsystematic risk of A into weight of A whole square is A square. Now we have to do a weighted average kind of feeling, but at unsystematic level. So unsystematic risk of A weight of A whole square plus unsystematic risk of B weight of B whole square plus 2 into A into B into correlation. But do you agree? Due to unsystematic factors, the correlation is always 0. Sir, when my company's CEO resign, this is an internal factor and unsystematic risk. Due to this, for example, I'm TCS, my CEO resigning, will it affect the SBI? The security SBI? No. The unsystematic factor gives the risk, but the two risks are not correlated at all. Change in one does not affect the change in another, which is why I'm saying it is, people in the class, 0. Which is people in the class, 0. So due to correlation, everyone in the class being 0, the entire terminology becomes 0. So what I'm left with rather is only A square plus B square, if you realize. Correct? Unsystematic of A weight of A whole square, unsystematic of B weight of B whole square. This is another formula to calculate the unsystematic risk of the portfolio. Sir, how would we calculate this? Depends on the data. For example, if examiner first ask you calculate security, first ask you to calculate the total risk of the portfolio. The first thing is total risk of the portfolio, for which it gives you the correlation covariance between the security. Then it is automatically giving you a hint to apply Markowitz and find a total. After finding the total of the portfolio, then it asks you to calculate systematic and then unsystematic. Then obviously it has a flow. However, Institute first asks you to break down the total into systematic and unsystematic. First it breaks it down to systematic and unsystematic, and then it asks you to calculate total. Then it asks you to calculate the total risk of the portfolio. You don't have to go this way, because covariance between the securities, correlation between the security has not been given. You don't have to go this way. You don't have to apply Markowitz. Rather, using the systematic risk of individual security, you can calculate the systematic risk of the portfolio. Sir, individual beta will give you portfolio beta, and using portfolio beta you can calculate the systematic variance of the portfolio. This plus this automatically takes you here. Using individual securities, unsystematic A square plus B square will automatically take you to unsystematic of portfolio, and using systematic and unsystematic of the portfolio, calculate total of the portfolio. Sir, this is the approach you will have to follow. I actually unfortunately mixed the two topics. Let me re-speak everything. First, I wanted to teach you how do you calculate it. If, listen to me carefully, if covariance between the security A be given, then you follow this approach so that you get total risk, minus systematic will get you unsystematic. If you have not been given the covariance between the security, that correlation A plus B whole square require correlation, if it is not given, then Markowitz you cannot apply, you cannot go here. Then in that case you go down and then you go come here, which is what my point was. First thing, this topic of calculating the unsystematic risk of the portfolio using both the methods, I hope is 100% clear. Once you have unsystematic variance, systematic and unsystematic variance, the under root will give you systematic and unsystematic standard deviations, right? Systematic and unsystematic standard deviations. Sorted. Sir, now before I take you final to a lot of practical question, I wanted to teach you something called as Sharpe index model. Sharpe created his own theory. Sharpe specifically focused on market to say that risk of a security or portfolio is linked to market. Return of a security or portfolio is linked to market. In fact, the correlation between the two securities, due to those securities are being correlated to market, the core or the base or the background of the entire concept of Sharpe was market. Yes. Sharpe says if you want to calculate the risk of a portfolio or risk of the portfolio specifically, then people in the class, to calculate the risk of the portfolio, one option is to go using Markowitz way. Sharpe says you can, rather than calculating the total risk of the portfolio using the total risk of individual security, rather than this you do otherwise. Rather than first calculating total using Markowitz, you can do otherwise. Sharpe says first calculate total variance, then first calculate systematic variance, then unsystematic variance, then total variance. That is what Sharpe is saying. Sharpe is saying what? Sharpe says total variance plus systematic variance plus unsystematic variance is the total variance you do. So you can do it at security level as well as at portfolio level. So if you do it at portfolio level, then there is no need to apply Markowitz, which is A plus B whole square. You can individually do systematic and unsystematic and add them to find total, and you can avoid Markowitz, is what is it saying. Sir, how do I calculate systematic of Sharpe? I mean, there is a possibility that you all might find multiple formulas learned simultaneously. But as we go to the practical question, you will see the application of that. I will link those questions to the concept, and then you will be able to better link it if in case you are confused. If not, then the life is really sorted, already sorted. What I want to say, systematic variance, how do you calculate? How much is the risk of market? How much is the risk of market? And relative to market, how much is my systematic risk, whether I'm a security or a portfolio? So SD of market into my security or portfolio's beta at squared level is systematic variance. Fine. Sir, portfolio beta, you know how to calculate, right? Individual security into beta into its weight, portfolio beta. And using that portfolio beta, I can have the portfolio systematic variance. Sir, what about portfolio unsystematic variance or security unsystematic variance? Security, if there is unsystematic variance, you can't calculate it except from total minus systematic. If I have been asked the total, then obviously I cannot do total minus systematic as unsystematic. So securities unsystematic variance or SD is always given. Portfolio unsystematic can be also calculated in two ways. Total minus systematic is unsystematic. But that logic you won't apply because I want a total. So how do I do total minus systematic? So another formula to calculate the unsystematic of the portfolio is using unsystematic of the security to get unsystematic of the portfolio. So that is what examiner is trying to say. Systematic and unsystematic, when you add at a variance level, you get the total of the variance, meaning to say total risk of the portfolio if you need. Option 1 is Markowitz. Security A total, security B total. And apply A plus B whole square formula to find out the portfolio total, for which you need correlation. So when you have correlation between the security, it is a hint that you have to follow this particular model, right? However, another option people in the class is what, please pay attention, another option is that, sir, using the systematic of individual security, calculate systematic of portfolio. Using the systematic, unsystematic of individual security, calculate unsystematic of portfolio. And when you add systematic and unsystematic, you get the total of the portfolio. This another model everyone in the class is called a Sharpe index model. Yes, everyone. Both of them. I want to speak a line, but it will rather confuse. So let's not speak that. Sir, now I will take you to the practical question where you will understand what exactly is to be done. After solving the practical question of this category, we're gonna take a break. Post break, we will continue further things, but let's first solve the practical question. Just give me a second. Listen to me. Following are the details of portfolio consisting of 3 shares, right? X, Y and Z, limited 3 shares are there. Portfolio weightage is 0.3, 0.5, 0.2, the beta is 0.5, 0.6, 1.2. Expected returns have been given, variance have been given, point of observation. The unit thing, especially in portfolio management, is really important because I'll give you multiple observations where a unit misunderstanding, lost the marks. For example, if this is in percentage 15, 16, 20, so the variance or the deviation of the returns at a squared level cannot be 0.02%. Can 15% only deviate by 0.02, that too at squared level? No. It is like multiplying it with 10,000 will give me the deviation in percentage terms. Fine. We have been given 3 security, their weight, their beta, their return and their total deviation. Market's standard deviation is 12, required to calculate portfolio beta. Right, very interesting practical question. I would request you all to pay 100% attention to it. I will try to link the question with the concept and make sure we all really get it without without any mug up. Right? Sir, portfolio beta, really easy. If I have individual betas and if I have their weights, so will I have, please observe what is going on. Systematic risk in beta terms of individual security we have and their weights in the portfolio we have. So can I have the systematic risk beta of the entire portfolio in relative terms at least? Sir, systematic risk of the portfolio when I do weighted average is 0.690. Fine sir, sorted life. Next. Residual variance of each of the 3 share. Residual variance means unsystematic variance of each of the 3 share. So you have these 3 shares. What is the unsystematic variance? Sir, for an individual security, as I said, there is no other way to calculate the risk residual variance except for balancing figure. From the total variance, if I can somehow deduct the systematic variance, what I'll be left with is unsystematic variance. That is everyone in the class, the only way out if I want to calculate. Yes. So sir, what is systematic variance of individual security? I said don't think formula, write formula but think flow. What is the systematic risk of market? Is its total risk, and relative to risk of the market, how much is the risk of security, and that to its squared level is systematic. Sir, now let's in this question, how do you solve the entire question in decimal terms? So 0.020 is total variance, decimal terms. Systematic. Risk of the market is 0.12 in decimal terms. SD is divided by 100, 0.12. Multiplied by beta is 0.5 into equal to is 0.0036. Yes. So 0.020 minus 0.0036 is unsystematic variance of 0.0164 of first security, that is in decimal. Sir, variance when is in percentage it is still 2 digits, but variance when it is in decimal it is still 6 digits after the decimal point, because 2 digits are anyways there. Divided by 10,000 has to go to till 6 digits, everyone in the class, because 10,000 has 4 zeros. Cool. So 0.01640. Similarly, total of second security is 0.010 minus the systematic variance. So 0.12 being market multiplied by 0.6 being I am relative to market, at squared level is 0.005184. From the total, when you deduct this, you get unsystematic variance 0.004816. Similarly for third security. So B part of the question which asks for the total residual variance gets done. C part, portfolio variance using Sharpe index model. Can portfolio variance be calculated using Markowitz also? But have we been given individual securities correlation between XY, YZ and ZX? No. Which is why we have to anyways use Sharpe. But sir, do you mean to say Sharpe does not require correlation between the security? No, Sharpe says everything is linked to market only. Between the two security, what is the linkage? Doesn't matter. Let's link it with the market. Sir, let's see how can the portfolio variance be calculated without security linkage? Sir, let's see. Systematic plus unsystematic of portfolio is total of the portfolio. Systematic of portfolio is how much is the risk of the market multiplied by relative to market, how many times is portfolio systematic risk at a squared level, plus unsystematic risk, how do you calculate of portfolio? Sir, if I have individual securities unsystematic risk, using individual securities unsystematic risk, can I calculate unsystematic risk of portfolio? It is A square plus B square. No 2AB, only A square plus B square. If there are 3 security, A square plus B square plus C square. Means unsystematic risk of security A, SD of security A into weight of security A whole square. Similarly, for the other 2 security will give me unsystematic of portfolio. If you add the 2, you get the total risk of the total variance of the portfolio. Do you realize neither in systematic variance of the portfolio nor in unsystematic variance of the portfolio I need the correlation between the 2 securities? Could I make you people imagine how could, with the Sharpe model, without covariance between the securities available to us, we can directly calculate the risk of the portfolio, variance of the portfolio? Are you all please understanding it with the depth I want to teach you with? Yes, people? So sir, with that, now let us proceed. We need to now speed up everyone in the class. Please look at this. Beta into market at square level, 0.12 into 0.69 into equal to is 0.006856. 0.006856 systematic variance of the portfolio. Unsystematic variance of the portfolio is SD, unsystematic SD of first security into weight of first security at squared level. So this is already squared because this is variance. So I just need to make the weight a square, right? So 0.014616400 into weights square 0.3 square, right? SD of a unsystematic variance of A into weight A is square. Unsystematic variance of B into weight of B is square. So unsystematic variance we have, the weight is 0.5 square. Unsystematic variance of C we have into the weight square. When you do solve it, you get the unsystematic variance of the entire portfolio. Systematic you have here, when you add the two, you get the total variance of the portfolio, which is 0.013507. Sir, when you multiply it with 10,000, it will be 135.07%. Having said that, the decimal answer will get you marks. Reason being, they start with decimal. In case of confusion, because return are percentage, these is decimal. In case of confusion, at the end, ultimately convert your answer to percentage also. Yes. Question 22 gets done, where what we have done? Sir, we have been given the total variance of individual security. Deducting systematic gave us unsystematic of security. Then in the third part, we did systematic of portfolio, we did unsystematic of portfolio, then we did total of the portfolio, which is what Sharpe is, which is what this part is. And then if you do SD, you get the total SD. Everyone in the class, I hope I could convey to you the entire story needed to learn. This, everyone in the class, this gives you the needed clarity. Are you all people in the class, please understanding it? Fine. So if you are 100% clear with it, let me figure out what should the next question be. Just give me a minute. After that question, we're gonna take a break. 22 is fine. 23rd, similar nature, easy question you can do frankly at your own. 24th is fine, 25th is fine, 26th is also fine, 27th is the question we should do. So to be able to do 26th question, just give me a second, hold on for a minute. Just trying to teach you something in 23rd question. When they say a specific SD of expected returns, a specific SD means a specific risk, means unsystematic risk has been given. Are you understanding? A specific risk is unsystematic standard deviation has been given here. So security unsystematic is given. Somehow you calculate security systematic. So the total of that will give you securities total is question number 23. Don't want to do it in the class, but just I want to give you a sense of it for your better comfort. Unsystematic of security given at SD level. Sir, we need to convert it to variance level. So unsystematic variance given. Systematic variance of security you can calculate as risk of market, and my beta will give you individual security systematic variance at squared level if you do. And systematic plus unsystematic variance will be total variance, that is part A, and part number B is again calculating portfolio risk using Sharpe. Portfolio risk using Sharpe, we anyways know, we have done it in the previous question. 24th question is also great. 24th question is great because in a single question it will make you apply Markowitz as well as Sharpe. Covariance between the securities given, use Markowitz, and the above data is given, use Sharpe. It is similar to the previous question that we have just done in the class. Similar to the previous question, 24th. 26th again is easy. Observe Institute give you the word called as random error, which is sigma error term of respective security. Sir, the denominations also for different calculations you should be comfortable with to interpret the data of the examiner, because if it is a square, we have to consider it as unsystematic variance. If it is not a square, we have to consider it as unsystematic SD. 27th question will be able to do only after we are done with the next concept. So for now, let's take a break. 12:26 it is. Let us take a 20-minute break. 12:45 is when we meet back to continue further concept and questions, and then we complete portfolio management. Yes, boss. 20-minute break, please. We gonna meet back at 12:45. Here's boss. So see you all after the break. Bye. All right. So people in the class, sorry for the 3-4 minutes of delay. Question 27th and onwards we can do now after learning this small concept, but for that you need to tell me, are you all there back please? People. Are you all back? Had your lunch? People? Shall we all proceed? Yes. So come on everyone in the class. Now we're gonna learn correlation between two securities. Sharpe, the model which focuses primarily on the market, says that the securities the two securities are never correlated directly. They are correlated to each other because both of them are correlated to market. The simple understanding automatically gives you the formula that security A is correlated to market by 0.8 coefficient of correlation. Similarly, the coefficient correlation between security B and market is 0.7. So with that logic, how much will be the coefficient correlation between the two security is 0.8 into 0.7, which is 0.56. That is what the logic of correlation between the two securities as per Sharpe is. Yes, people, this is sufficient enough for you to solve the practical question, question number 27 of the study material. Sir, this question is also in the study material. Let's learn what it says. Study of mutual fund has revealed the following data. What is the data? That there are three securities ABC. The standard deviation of the securities has been given. Correlation with index, which means row of this security with the index or with the market has been given. The standard deviation of market is 15%. Fine. What is the sensitivity of return of each stock with respect to market? Sir, the language is really important to understand. Sensitivity of return of each stock means sensitivity means change in something due to change in something. So with respect to market, how much is the change in the stock? Sir, it is basically asking you to calculate beta. If you realize, sir, do we have sufficient data to calculate beta? Correlation of security and market multiplied by SD of security divided by SD of market is sufficient enough to calculate beta. So 20 multiplied by 0.6 divided by 15 give me 0.8 as the beta of a security. Similarly, other two securities beta you can get. Fine. Next, what are the covariances among various stock? How are the two securities are correlated? What is the covariance between the security? Please observe there is a difference. We have been given the correlation, but that is between security and market. That is between security and market, and we have been asked it with the securities. Fine. Now, if you suppose you are not in a particular topic, you are in the exam hall. You see that I have to calculate covariance between stock, and you should know that there are only two ways I have taught you covariance. The first, my deviation into your deviation summation divided by n. I mean the one which is calculated using possible returns of individual stock, which is not given here. Then only option you have is Sharpe model, which is what? Sir, using the correlation of individual stock with the market, I can calculate correlation between the security. And once I have the correlation between the security, I can also have the covariance between security. So 0.6 multiplied by 0.95 give me 0.57 as the correlation, which is nothing but covariance divided by SD of 20 and SD of 18. Correlation is what? Covariance divided by SD. So these SDs if you multiply here, so 0.57 multiplied by 20 multiplied by 18 give me 205.2 as the covariance between the securities AB. Similarly, covariance between BC will be this into this into this into this. So 0.95 into 0.75 into 18 into 12 is 153.9. People in the class is covariance between the securities BC. Yes, that's how you proceed to calculate the covariance among further stocks. What would be the risk of the portfolio consisting of all three stocks equally? Risk of the portfolio. Sir, risk is to be calculated at portfolio level. Two choices you have, Markowitz, Sharpe. Markowitz a plus b whole square, a plus b plus c whole square, Sharpe systematic plus unsystematic. Sir, since we have covariance between the individual stocks now, it is better to use Markowitz because it automatically gives you the hint to use Markowitz, which make use of covariance between the security. A square plus b square plus c square. So SD of A, weight of A is 1 by 3 whole square. So 20 divided by 3 into equal to m plus. 18 divided by 3 into equal to m plus. 12 divided by 3 into equal to m plus. So A square plus b square plus c square plus 2 into SD, 2 into weight of A, weight of B, covariance between the securities AB, the one that you calculated 205.2. So we are done with A square plus B square plus C square. 2 into weight plus covariance AB. 2 into weight into covariance BC. 2 into weight into covariance CA. So this plus this plus this into plus this plus this plus this automatically give you the variance between the securities, right? So when you do calculate it, we are not wasting time to calculate, but when you simply calculate, you'll get the covariance as variance of the portfolio as 200 and 200.24. I'm really sorry if I spoken anything incorrect. I want to repeat the line. When you do solve this formula, using Markowitz, you are able to calculate the variance of the portfolio. What has the institute asked? Risk of the portfolio. Means you have to now under root to calculate the standard deviation, which is 200.24 under root is 14.15. Third part gets done. In this question, I wanted to teach you this particularly two things. First, individual securities correlation with market gives you correlation between the two security first. Second, deciding which model is appropriate, Markowitz versus Sharpe. Next, what is the beta of the portfolio? Consisting equal investment. So if I have individual beta, if I add them up divided by 3, give me weighted average beta, which is 0.847. That is also fine. What is total systematic and unsystematic risk of the portfolio? Based on the language we need to learn, how do you find the systematic and unsystematic? One option. Please, you have to understand what is going on and then figure out the rhythm of the question. Let's go to the question. They have asked you to calculate systematic and unsystematic of the portfolio. You already have total. Which method do you think is more preferable? Option 1, individual securities total you have. From that you deduct individual securities systematic so that you can calculate individual securities unsystematic. Then using individual security systematic you calculate portfolio systematic, using individual securities unsystematic you calculate portfolio unsystematic. This is option 1. Option 2, you already have portfolio total. If you deduct portfolio systematic, the balancing figure will be portfolios unsystematic. What do you think is preferable? So obviously method number 2, less effort taking. So if we can calculate using the beta of the portfolio, can we calculate the systematic variance of the portfolio? Yes. How much is the risk of market? 15. And relative to market, how much is my risk? 0.847 times at squared level, right? So 15 into 0.847 at squared level is 161.42. So out of the total risk, if systematic is 161, unsystematic is 31, under root of which is 6.23 as unsystematic SD, which solves question number 27. A really good question. So you have in this category solved around 2 questions and slightly discussed a third question, which was question number 23rd that we discussed. Now, to be able to solve further question, let's learn further concepts. Sir, in Sharpe index model, you have 3 things to learn. Where's Sharpe? Here. In Sharpe, you have 3 things to learn. Which 3 things? Wait. Thing number 1, risk using Sharpe. Thing number 2, covariance or variance between the correlation, covariance or correlation between the securities using Sharpe. And third is return, expected return based on the thought of Sharpe, which is again extremely interesting. So for that we have to take a help of the graph. Let me very quickly summarize for some people who already know the underlying logic so that you get a revision of it. The objective is not to explain that background from the scratch, just narrating it so that you can recollect something. Sir, when we created in the class this graph, I said for example, let's take the data of past so many years. For a given particular market returns in the past, my security would have generated some return. So using those data, let's plot that data on the graph. So we get so many dots which represents, every dot represents the data point, right? When I create a line of this between these dots, which is somewhere, not the exact, somewhere the average of these lines, then this average line is called as security characteristic line. This is the line as per Sharpe index model which helped me to predict the market, the security return, that helped me to find the expected return of security given you have the expected return of market, right? Sir, with this line, when the market's return is this, I can with the help of this graph figure out that okay, security return is going to be this, right? This is the security return for this market return. If market return is this, then accordingly the security return will be this. So rather than knowing only the line, we should also be able to know also an equation of line. Sir, equation of a line I taught to you in the class is equal to y is equals to x plus c. Now what I speak is for everyone in the class. So listen to me. CA finalist, there's someone in the CA final saying how long will it continue? At least for an hour. At least an hour, I believe it will continue. Cool. 1.5 hours. Being on a safer side, I'll say. Right? Sir, y is equal to mx plus c is the equation of line. Did you know what used to be x and y? X used to be independent variable, y used to be dependent variable. Meaning to say in our case, securities return is being dependent on market. So return on market is independent and return of security is a dependent variable on market. So in place of y, I will say security return. In place of x, I will say market return. Sir, slope of it used to be beta. The logic is here. Slope of this line, which is m used to be beta and alpha used to be the constant term, intercept term, meaning to say even if the x is 0, even if the market gives 0 return, has the security given any return? Yes sir, security gave this return even if the market is 0. When the market is 0, security gave you this return, so that is your alpha. That is the equation of characteristic line. Whenever examiner asks you to create or form an equation, listen to me guys carefully. Whenever examiner asks me to form an equation or create an equation, you have to please realize you should be able to always know what are the variables in any given equation. What are the variables? Sir, why? Because variables in an equation are kept as it is, and at other places you put a number. For example, alpha we will need to put a number, beta we will need to put a number, but these other variables will remain as it is, and that is how the equation look like. Which means to be able to, now how will the question be? Examiner give me past data of security return and market returns. Using the past data, I'll have to first find beta. Using that, I'll have to first find alpha, and then the equation is automatically ready. That simple the question is going to be. Yes? Let me now tell you alpha. How does the equation look like? Return of a security, expected return of security depends on expected return of market. So whatever is the expected return of market multiplied by beta plus the alpha of the security will give you expected return of security. The same thing can apply at portfolio level as well. First. Second, the alpha everyone in the class can be both positive and negative, that you should know. Right? This is positive alpha, this is negative alpha. When the market return is 0, please observe the security return is going negative. That is, people in the class, negative alpha. Right? Last. Slope, M, slope is beta of that security, the derivation of which I am not discussing. Just trying to tell you, security characteristic line is a part of Sharpe index model which help you to predict the expected rate of return, based on which a practical question is really there. Question number 28. Rates of return for company X and market portfolio for 10 period. Sir, company X, even if it is company X, I have to assume security as X and security as Y and market as X. So for the past 10 years, security and market possible return given, what is beta and then what is characteristic line. When it comes to beta calculation for past data, I have two choice: correlation method, regression method. Directly beta is asked, regression method will do. No need to apply correlation method. Sir, period X and Y, next column XY, then column is XS square. What is the formula? Click, 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 click. Think of it at your own once before I proceed. What is the formula? Summation xy minus n into x bar y bar, summation xy into minus n into x bar y bar divided by summation x square minus n into x bar square. Sir, not solving it, trying to teach you x into y, xy, x square is x square. The total of it is summation xy and summation x square. 2157 minus 10 into 12 and 15 being the x bar and y bar. Then 2146 minus 10 into x bar 12 square. When you solve, the beta is 0.506, which is the first part of the question. Now asking for the characteristic line. Look at the beauty. For characteristic line, I need alpha also. Is there a formula to solve alpha in the entire portfolio management? No. For characteristic line, the alpha is always calculated using the equation of characteristic line only. Sir, in the line I just got beta. Expected and required rate of return, sir, you said our variables will remain as it is, no numbers. So how do I calculate alpha? Sir, only for the sake of calculating alpha, try to put the expected return of security in market means x bar and y bar to the equation, only for the sake of calculating alpha. That average return of market has been this. The beta, which is also somewhere based on average, is this. So the average return of security has been this. So what has been the average alpha in the past that you calculate? Could you connect to what I said? If you could connect, please observe it. Sir, beta is 0.507 as you see, 0.506. Market return is 12, security is 15. So 15 is equal to 0.506 into 12 plus alpha. When you solve this equation, you get the alpha as 8.93%. Overall equation, security return continue to remain as it is, nothing in its place, it is a variable, is equal to return of market into beta plus alpha. Are you all able to now connect? As the market returns will change up and down, security return will automatically change up and down. That is what the simple plan for question 28 will be. I hope I am able to convey to you the entire question. The next category of question people in the class will require us to learn CAPM. Capital asset pricing model. Capital asset pricing model which has security market line. As I said, every line has an equation or every equation has a line. CAPM equation is really clear to us. Required rate of return is equal to RF plus beta into RM minus RF. Can I say? Primarily, this line gives us the required rate of return. In the chapter of equity business valuation, I told you that required rate of return sometimes is interchangeably used with expected rate of return, but the two things are different. In this concept, I will teach you that why required and expected rate of returns are these two words being used interchangeably. Let me try to explain. Yes, boss? So everyone in the class, please be present. Try to understand what's going on. Sir, in this equation, what is dependent variable and what is independent variable? I said in the class, you apply common sense, you get it. Required rate of return depends on the risk. Automatically you get risk is independent, risk is represented by beta is independent, and return depends on the risk you take. So RF, RM minus RF, all these things are not variables. These are the places where you put numbers. required and beta remains same, and that's how the equation of security market line or equation of SML will look like. So examiner asks you to create the equation, RF, RM, put numbers, equation is ready, first thing. Second, this equation tells you the required rate of return. Suppose RM, RF data has been given, RM 6, RF 2. Suppose the beta is 2, then how much should the return as per CAPM be? As per CAPM, the return should be 10. This equation says if the return is 2, then as per CAPM, if the beta is 2, return should be 10. When I actually analyze the data, so 10 is my required return. When I actually analyze the security, try to predict its P1 and try to calculate the expected rate of return, it is turning out to be 12. So when the expected rate of return is more than required, apply common sense. What you require is 10, but what you think you will get is 12. Isn't it a good deal? Yes, you buy the security, security is considered undervalued. Similarly, sir, third, suppose a security B is there whose required is 14, but you are expecting to get 8. When expected is what you get is less than what you require, the security is not good, you sell it, it's considered overvalued. And the last case, if the two are equal, required is expected, then the security is considered fairly valued, and that's when you hold it. Which means every time in the valuation chapter when required was interchangeably used with the expected, we assumed the security to be fairly valued. Is it? The answer is yes. Sir, what kind of questions institute can ask from this topic? I will tell you, but before that, let me summarize a few more things for you. Sir, beta is the systematic risk you know. RM minus RF is the market risk premium you should know. When you multiply the beta to it, it is called as security risk premium. When you multiply beta to it, what is it called as? It is called as security risk premium. First thing. Second, sir, security market line is this line which is nothing but a graphical presentation of this equation. Third, from MCQ point of view. Above security market line, if there is any securities expected return, then all those securities are undervalued, because if the expected is more, required is less. If the expected is more, required is less, then it is buy securities undervalued security. If securities expected return is below the line of security market line, then it is overvalued securities because expected is less than required. If it is on the security market line, then it is fairly valued security. Just I thought if in case from MCQ point of view, we have to learn it. Always, you must be thinking, sir, how do we remember the variables? Because beta is here also, beta is here also. In characteristic line, beta is not variable, but out here in the CAPM, beta is variable. How do you remember? Really easy. Sir, CAPM tells you the required rate of return. Required rate of return depends on the risk, which is beta. So beta has to be variable here and required rate of return has to be another variable, obviously. Sir, in this case, the expected rate of return does not depend on the risk. It depends on the market rate of return. How much market is going to get will decide how much you are going to get. That is the base of Sharpe, right? So market rate of return automatically become independent variable. I'm trying to literally share every possible depth that I can with you people. Perfect. So sir, that is also fine and sorted. Cool. So I hope the way we are learning the things is really very different and creative than how it is generally there in the market. So try to keep your imagination on. When you have the question of CAPM, this page you should be able to imagine in your brains and solve the practical questions. Similarly, when you see the question of security characteristic line, you should be able to imagine this page at your own and be able to do it. Perfect. Sir, taking you ahead to the last thing, how is the practical question being asked? Institute give you the data. Using that data, you calculate expected rate of return. Sir, how do we calculate expected rate of return? Array boss, X by var bar. The very first question of portfolio management, fine. Institute may ask you to calculate required rate of return. Sir, how? You will have to first calculate beta of a security. RM, RF if given, you calculate required. Comparing expected and required will give you the idea of under overvalued. Listen to the most important thing I speak now. In the entire chapter, buying and selling decision of security can be taken in two ways, right? Sir, either you compare market price and the intrinsic value, which was there in the equity business valuation chapter, or you compare expected and required rate of return, which is there in the portfolio management, right? In terms of OutNotes, it's page number 18 and 21. In terms of OutScanner, these are respective question of portfolio management chapter. So the decision of buying, selling in the exam, when you see it is one of the two possibilities, either portfolio management comparing required expected or valuation comparing MPS intrinsic value. Accordingly, you should have accordingly you'll be able to connect to how should the question be solved. Yes. So if we are clear, second possibility of question is creating the equation of SML, which is going to be easy. Fine. So let's proceed to the practical question. Back to back, so many practical questions we'll have to do in this category. First practical question, question number 30th. Come on. Investor hold to stock AB. Analyst prepared the probability distribution that these are the probability of shares going this return and market giving this return. Risk-free rate 11%. Determine whether the investor should liquidate, which means sell the securities, or buy the securities, which is contrary, make fresh investment. This is the thing you will have to answer. Sir, let's check them one by one. Let's check them one. So basically, do you realize based on the question that question is simply about buying and selling of securities. Yes. The question is simply whether we should buy or sell the security. Now, do you observe examiner has not given CMP, intrinsic value, nothing has been given. How would you take the buying selling decision? Using expected and required. Let's plan it. If I have individual possible return with the probability, can you find out expected? Yes, sir, really easy. Now, what for the required you need? I need RF, which is given. I need RM. So data of market with the probability given. RM is also fine. Then I need beta. Oh my God. For beta, you need correlation into SD by SD, which means you need that 10 columnar table of correlation into SD by SD will give me beta ultimately. That's how I solve the question. Yes. So let's create that 10 columnar table for security and market. Market will be considered X, security will be considered Y. Probability 0.4, 0.3, 0.3. 18, 13 minus 3 being market. So X bar is 10.2. P into dx square, which means deviation at squared level with the effect of probability means the weighted average deviation at squared level is 78.96. Fine. Sir, security A 25, 10 minus 5. The Y bar is 11.5. The deviations are this. Sir, why is there no column P into dy square? As I said again, if you use covariance divided by variance formula, which is preferable, which saves your time, then there is no need for SD of security. Covariance is there, variance is there. Covariance between security market and variance of market. For X, you need to find out P into dx square. For Y, there is no need to find out P into dy square. Dy you need for the sake of covariance. So dx into dy into probability will give you the covariance as 106.2. Not solving the same table again and again in multiple questions. Now you all realize. Yes. Cool. So sir, covariance is 106 divided by 9. 106 is covariance divided by 78.96. Broadly, 1.345 is the beta. 3 digits after decimal point. Sir, if I have beta, do I have RF? Yes, 11. Do I have the expected return of market RM? Yes, sir, 10.2. So RM minus RF into beta plus RF gives you the CAPM required rate of return of 9.92%. Correct? Required is 9.92. Expected from the security is 11.5. The expected, what I'm going to get is more than how much I need to get. Makes me understand I should make a fresh investment. That is what question number 30 is about. Right? The same for security B you will have to do. I hope I'm able to clearly convey to you what is to be done in the question. Just give me a second. Question number 30 gets done. Next question we're gonna do is question 34th. Again an application of it, but this time we will not compare expected versus required. This time we'll compare CMP versus intrinsic value. Question 34th, come on. Investor is holding 5,000 shares of X Limited. Fine sir. Current year dividend is rupee 3 per share. Market price of the same share is rupee 40. So we have quantity of share we hold D0 as 3, market price 40. Investor is concerned about several factors likely to change. For example, in the current year where dividend paid is 3, risk-free rate is 12, market risk premium RM minus RF is 5, beta is 1.3 and growth is 9. In the next year, anticipated dividend will be 2.5 and other details will be as below, whether you should buy, sell or hold. Given the data, you have two choices: expected, required or IMP CV. First preference is comparing intrinsic value with the CMP. Have we been given the CMP? Yes. Is it possible for us to calculate intrinsic value? Yes, Gordon's model. Although this question belongs to equity business valuation chapter, security valuation chapter, but you would be able to connect to the Gordon's. D1 divided by K minus G. Sir, do we have the K? Yes, sir. Risk-free rate, beta, market risk premium we have. It's extremely easy. Sir, 1.3 into 5 plus 12 is 18.5 as the K. Here the K is 15.6. D0, dividend paid, into 1 plus G. So 3 plus 9% divided by K of 18.5 minus G of 9 give you 33.42. Logical? Easy. Ambiguity is, they say anticipated dividend per share. For next year, it obviously means D1, but institute assumes it D0. In May 24, those who did not remember it and considered it as D1 lost the marks. You will have to, as it is, continue to follow even 2.5 as D0 despite being mentioned as next year and anticipated. 2.5 plus 7% growth divided by 15.6% minus 7% give you the price of 31.1. You will have to make the individual comment. Based on present parameter, market price is more than intrinsic value, overvalued. Based on revised parameter, again, market price is more than intrinsic value, the share is overvalued. Correct? Another category of this type we have discussed, 34. The next category we gonna discuss is category 41. Another interesting question. 41. I'm trying to cover one question of each type so that you get the needed comfort. Now we'll discuss the question related to security market line creation. And in that also a typical question, right? Expected return of two stock for market returns are given below. There is this stock called as aggressive, there is a stock called as defensive. In the bearish case, when the market gives 7% return, stock give 4 and 9 return. In the bullish case, when the market give 25% return, aggressive stock give 40 and 80% return. Yes, you are required to calculate the betas of the two stocks. What are the betas of the two stocks? Sir, what are the betas? Sir, beta calculation in this question can be simply done by whatever you think. For example, you may apply correlation, regression, whatever you apply. The simple way, whenever we have only two data points given, two returns given, then the formula of change divided by change can also apply. Change in security return due to change in market return is beta. So 40 minus 4 divided by 25 minus 7. So it is 36 divided by 18 give me 2 times of beta. Aggressive stock 2 times beta, defensive stock 0.5 times beta, easy method. Will we get marks? Most probably you should. Sir, second, The expected return of each stock if the market is equally like to be 725. If you have 50% chance of 7 and 50% chance of 25, then how much is the expected return of stock? Simple. It automatically means 50% chance of 4 and 50% chance of 40. When you do this, the expected return is 22 for aggressive stock and similarly something for defensive. Easy. Third part. The security market line, if the RF is 7.5, RM is equally likely to be 7 and 25. So 7 plus 25 divided by 2 is 16. So basically if RF is 7.5 and RM is 16, what is security market line? Basically, what is the equation of security market line? So everyone in the class, you all should realize a very simple thing. In this entire equation of CAPM, what are my dependent variables? Dependent variable is required rate of return, which depends on beta. Which means RF and RM, if I put the value 7.5 and 16 minus 7.5, if I put the value, automatically I get the equation of CAPM. Sir, 7.5 plus beta into 8.5 is equal to required rate of return of a security is the equation. Sir, that is how part number C is. D is alpha of the two stock as per Sharpe index model. Sir, alpha we have read in the characteristic line. The equation was for security market line. Security market line tells me required rate of return. Characteristic line tells me the expected rate of return, and Sharpe index model is mentioned, not the characteristic line. Let me tell you a particular thing. How many of you, those who have not taken any batch from me, I'm asking you people, how many of you knew the concept of characteristic line? Most of you. If you don't knew what is characteristic line, then you are out of the game. If you knew that there is something called as characteristic line, then how many of you knew that characteristic line is a part of Sharpe index model, boss? Did you know? That characteristic line is a part of Sharpe index model? If you really think this is a small thing which has added value to you, then the OutNotes deserve at least a like on this video. Why? Because when examiner asks you that calculate the alpha, as per Sharpe index model, you have this conceptual clarity that Sharpe index model means characteristic line, and alpha of the characteristic line is what the examiner is asking. Sir, your OutNotes, let me tell you, are so well organized that you have to just make use of it. Try to understand the things with the best possibilities. When we write down at our own in the handmade notes, no one can create the notes with this beauty which is there in the OutNotes. Even I cannot. When I type down everything. Yes. So make the best use of OutNotes which is there, and let me tell you, with the understanding that you are doing, you can really make a difference. You can really, score even an exemption with the help of the revision videos that you are watching and with the help of question bank, which is OutScanner. Yes, that is the level with which we are doing the revisions, frankly. Everyone. Sir, question 41. D part asks for calculation of alpha as per characteristic line. Do you remember I said alpha has no other method except to use the characteristic line itself? So characteristic line says return of a security, say 40%, is nothing but beta of that security into return of market plus alpha. Yes. So if you have everything ready, calculate alpha, it is minus 10%. That is what the answer to aggressive stock. And the similar thing you will have to do for defensive. Characteristic line, every security has a different equation, right? Every security has a different equation. So that is what you will have to do even for the defensive. Alphas of the two stocks they have been asked to calculate. Question 41 gets done. Another great question of a particular type. See, 43, easy question not to be done. But another great question, why do I call it great? Despite it is all pinged, marked as ambiguous, I'm calling it great. You know why? Because despite it being ambiguous question, Institute has repeatedly asked this category of question in the different attempts. In RTPs, MTPs, an institute is modifying, creating new pattern of this ambiguous question in the exams, RTPs, MTPs. There are total 6 variation of this ambiguous question. 3 variations are exam question, other 3 variations are RTP, MTP question. The first 3 variation, which has been exam repeated questions and also there in the study material, we will do. Because it is ambiguous, we'll have to mug up. The other 3 question has higher level of ambiguity and not being asked in the exam, so we will not cover it. To be able to do the first 3 doing question 44 is sufficient. 45th and 46th question belong to the same nature which you will be able to then do at your own. So let's do 44th question once, everyone. X hold the following portfolio. What is the portfolio? Equity share of A, B and C Limited there is, and PSU bonds are there. In my portfolio, there are 4 securities where the cost of investment is this, dividend I earned is this, the market price right now is this, and the beta is this. Risk-free rate 12%. You have to calculate the expected rate of return using CAPM. Apply your brains. You need to do CAPM, expected rate of return calculation. Easy, basic. Now you tell me the expected rate of return require RF plus beta into RM minus RF. Sir, do you have the RF ready? Yes. Do you have the individual security beta ready? Yes. Do you have the RM ready? No. So ambiguity 1, RM is not there. How did Institute do it? Institute assumed the given portfolio of 4 securities as the market. So whatever is the return of these 4 security turned out to be the return of the market is what it is. Yes, are you understanding? Turned out to be the return of market is the first thing. Sir, so you have to realize that the return of this entire portfolio is simply calculated on an aggregate basis. Aggregate basis means how much was the total cost, how much has been the total dividend, and how much has become the price. Now assuming it to be P1, it to be dividend, and it to be P0. When I do P1 minus P0 plus D, so 146 minus 136 plus 11600 divided by 136 give me 15.88% return, which has been assumed RM. This RM, this RF and individual betas are used for CAPM. So 15.88 minus 12. 15.88 minus 12 into the beta of 0.9 plus 12 is 15.49%, being the return of first security as per CAPM. Similarly, other 3 securities as per CAPM. Next, they are asking the average return of the portfolio. Sir, I just calculated the return on the portfolio. This time, they want you to calculate the return as per CAPM. So for the entire portfolio, can we apply CAPM? Yes. The logic is really simple. Rather than beta of a security, when you do it for the portfolio, you use beta of the portfolio, so you get the required rate of return of the entire portfolio. RMRF remain the same. But for beta of the portfolio people, the point to remember is that you have to use a simple average. That is another ambiguity. Despite the investment being different in different securities at present, despite the investment being different at different security, please understand the betas everyone in the class are the weighted average beta is calculated using simple average. You will have to mug it up and follow these 2 ambiguities as it is in the exam. 0.9, 0.8, 0.6, 0.4 give me the weighted average beta of 0.675. Use that weighted average beta. Give you the simple average beta, use that simple average beta to calculate the CAPM return, where RM and RF we already know. This was question 44th. Similar question is 45th. You will have to do it at your own, the differences. In 44, RF given, return of the portfolio asked. In 45th question, return of the portfolio given and RF has been asked, you will be able to manage it 100% at your own. 44th question gets done. And this is where people, this is where, since as I said, some questions you don't need to do, they are there in the MTP, RTP, but as higher level of ambiguity. Then there are some questions which are actually out of the syllabus asked by the institute once, but there's no point of doing them. The next question. Now let me be transparent as I'm there in every revision video. Wherever I feel that something is unfair to be put on this video because the time taken is really more and the probability of it coming in the exam is really less, we don't do it. There was one such topic I remember in derivative or forex, and there is one such topic here. The concept of Sharpe optimal portfolio. To be able to do this question, you need to really apply this monster formula. This monster formula you should be able to apply not once. You will have to apply this formula 6 times to be able to solve this. After getting this, you need to reapply this formula. And once you reapply this formula, then ultimately the solution happens. So the solution starts from here, applying this formula through the table. Having done all this, it has not been asked in the past at least 36 attempts. In 15 years, there have been 36 exams. I mean to say, it has not been asked. Doesn't make sense to do question number 51 in the class. Yes, people? Further question will be able to do, and for that we have to move to the next category and the last category called as other important topics. Fine. A really interesting category. For that you will have to give me just a minute of break. Let me settle down. 4 topics in this category we need to cover up to be able to solve its to be able to complete the portfolio management. Yes. Hopefully in the next 1 hour we should be able to do the portfolio management. Hopefully. Let's see how it goes. Having said that, for the sake of completing it on time, we are not going to do any compromise in the learnings. Guys, if you're watching it till here, if you've really found so far the lecture to be helpful, logical, detailed, please put up your genuine feedbacks in the comment section of this video so that any student who's a new learner, basically your comment help him understand if the video really makes sense or not, and even I will get to know. So if you do comment, it gives me the confidence that okay, this is something which has helped you. To me, I am already confident the level of content being delivered, the detailings, the question solving, the OutNotes, OutScanner, things have been perfect. However, your experience should reach to me, right? So please comment down whatever your genuine feelings are with respect to this video, right? And as I said, you can enjoy, take benefit of other such videos available. The playlist link is in the description. Fine. So just give me a minute, then we all continue. All right. All right. Shall we all now continue? People, are all there? So come on. So basically, in the other important topics, I have compiled all those topics which have got no direct relation with previous topics, has no direct linkage in sequence, right? One is arbitrage pricing theory. It is nothing but an extension of CAPM, right? Where CAPM says RF plus beta into RM minus RF, whether you call it expected or required. You know what is arbitrage pricing theory? RF remains as it is. CAPM's, so basically arbitrage pricing theory, everyone, extends this particular part of beta into RM minus RF. Sir, how does it extend? Really simple. RM minus RF tells you the extra return. Market risk premium is nothing but the extra return you get for taking extra risk. So this is the extra return in the market multiplied by the risk factor, the systematic risk of a security. This is the case. Arbitrage pricing theory does the same thing, but it does for different risk factor. Arbitrage pricing theory says rather than considering a single, single risk premium and single risk factor, which in the market, which has all the risk, market has all the risk, like the risk of GDP, risk related to inflation, risk related to interest rate, foreign exchange. So why don't you take for all these risk factors separately, why don't you take the market risk premium of that factor and the beta of the security for that particular risk factor? For example, GDP is the risk. So it's a theoretical model, so please consider it. GDP is the risk factor. For the risk of GDP, how much is the risk premium in the market called as factor risk premium? Multiplied by how much risk your security has for that particular factor is called as beta of this factor for that particular security. Similarly, another securities risk premium that market has multiplies by beta of your security, third factor into third factor's risk premium into its beta plus the risk-free rate of return is the logic of arbitrage. Main point of learning. Factor risk premiums does not belong to security, they belong to market. Whether it is security A, B or C, the factor risk premium remains same. It is the extra return given in the market or earned in the market for extra risk of GDP or forex or any particular risk you take. Beta of every security for different factors will be different. Yes, I think this is enough for us to solve the practical question. Let's solve practical question number 53. Has a small, see, let me tell you frankly, in this topic, questions have been limited and that too with ambiguity, unfortunately, right? However, let's try our best to at least do the questions which are already there. Even if there is some element of remembrance, let's remember it so that the same question we are able to solve if needed in the exam. Come on. So super fast, please see this. Nirmal Kumar has categorized all available stock in the following types. Small cap growth, small cap value, large cap growth, large cap value. So the entire market has been broken down into 4 categories. These are the 4 categories. What is the weightage of those 4 categories in the entire market? 25, 10, 50 and 15% is the weightage. So we have been given the weights of it. Fine. Further, sensitivity of return of category with 3 important factors are estimated. Sensitivity means beta. So for there are 3 factors. Factor 1, third factor is inflation, which looks logical. Second factor is book price. What does this factor mean? I don't know. First factor is beta itself. Sir, how can beta be the risk factor? Beta is a measure to measure the risk, that is entire risk of the market, not a particular risk like inflation or forex. How can this be a factor? It is. That is the ambiguity. Except that everything is logical. Sir, so for these 3 factors, small cap growth has this beta, small cap value has this beta, and so on for the other 2 category where the risk premium, factor risk premium in the market, this and this. Risk-free rate 4.5% determine arbitrage pricing theory return. Sir, For the entire market, for the market I want the return. So let me first of all find out the return for individual category using arbitrage pricing, and then I will do the weighted average of those returns. So first, sir, RF 4.5 plus beta into factor risk premium plus beta into factor risk premium plus beta into factor risk premium. So 4.5 plus beta of 0.8 plus factor risk premium of 6.85 plus beta of 1.39 factor risk premium of negative 3.5. Similarly, third, give you 5.99 a small cap growth arbitrage pricing return, expected return. The same you do for all other securities. So you get the arbitrage pricing return as this. Having the weight of 25, 10, 50, 15, when you do the weighted average, 5.99 into 25, 8.85 is 10, 8.48 is 50 and 7.54 is 15. When you do the weighted average, you get 7.75% as the expected rate of return in the market as per arbitrage pricing theory. Next is using CAPM, determine expected rate of return. CAPM only require beta, which is there. So there are two ways. Again, for market I need. So first calculate individual security CAPM and then do the weighted average. For example, RF is 4.5 plus RM minus RF is 6.85 into beta. That you do for all four security and then do the weighted average. Or option 2, do the weighted average of beta first and then apply CAPM. So examiner has done the second thing. You can do whatever you want. Examiner say beta into weight, beta into weight, beta into weight, beta into weight gets you 1 beta of the market, which is also practically correct. 1 is the beta of market. That when you calculate, multiplying the beta with RF plus RM minus RF give you 11.35 as the CAPM return. Getting it? So that is also done. C. Nirmal Kumar. C is really an interesting question. Please look at this. Nirmal Kumar, people in the class pay attention. Nirmal Kumar wants to construct a portfolio constituting only small cap value and large cap growth stock. Small cap value, large cap value stock I want to create. If the target beta for the desired portfolio is 1, individual betas are this. For the in the portfolio, individual security beta is this. They should have some weight, which I don't know. W and 1 minus W. Whose weighted average I want to create 1. Weighted average I want to create 1. So how much should the weights be? So 0.9 into W and 1.165 is 1 minus W. The weighted average of this is 1. So how much should the W and 1 minus W be? If you solve this equation, I hope you got it. First security into its weight. Sorry, beta of first security into its weight. Beta of second security into its weight. So beta into weight gives is equal to the weighted average, which I know is 1. Individual securities weight, if I have betas and their weights, if I have the weighted average, everyone is 1. So if you have the weighted average beta, can you back calculate the weights? Yes, and that is what institute has asked you to do. Question 53rd gets done, right? Except for the ambiguity which I tried to explain, it is all good. 54th, won't do the entire question, just try to help you understand it on a lighter note. Question number 54, please come to it. 54, please come to it. Mr. X own the following portfolio: A, B and risk-free security. I have 3 securities in my portfolio. Factor 1 sensitivity means beta. Since there are different factors, again I got to know it is a arbitrage pricing theory, right? First factor, if I talk about the risk of first factor, security A beta is 0.8 and for security A, second factor is 0.6 and the expected rate of return, my god, expected rate of return is given to me. Generally betas and risk premiums are given and expected return are being asked. Fine. Security B, 1.5 beta factor 1, 1.2 beta factor 2 and 20% return. Similarly, risk-free security has no risk. Assume that security returns are generated by 2-factor model. Fine. Mr. X has 1 lakh rupees to invest. Sell short 150 of security B and purchase 150 of security A. What is the sensitivity of Mr. X portfolio for the two factors? Wow, what a question. It deserves. It deserves good marks. This question deserves good marks. Correct? Just give me a sec. Correct. So come on. One second. Yeah. Sir, I have been given, first of all, the amounts in a different manner. There is a long as well as short position. So let's try to create a portfolio. I have 1 lakh rupee of my own. What I'm doing, I am borrowing 50,000 rupee. Do you remember I just taught you borrowing is a negative market value is considered short, and using that 1,50,000 I purchase 1,50,000 of another security, right? If I convert them to weights, if this is 100%, please let me try to teach you how do you convert percentage absolute amount to percentage weight. Whatever you have is always equal to 100% fund, which is 1 lakh is equal to 100%. So 150 is 150% and 50,000 is negative 50%. These are the weights. Now, whenever you do have to do weighted average of anything, these are the weights. Sir, X has whatever. What is the sensitivity of Mr. X portfolio for the two factors? What they are trying to say? If in the security A, I invest 150%. If in the security B, I invest negative 50%. For factor 1 and factor 2 separately, what is my portfolio sensitivity? Which means for factor 1, the portfolio has 0.8 is the sensitivity for 150% of the security and 1.5 is the sensitivity for negative 50% of security. So overall portfolio of both the security, how much the sensitivity for factor 1 is the approach. Yes, please observe, please observe. 0.8 into 150%, right? 0.8 into 150% m plus 1.5 into 50 negative percent m plus memory recollect is 0.45 as the beta for factor 1. The way you have done it in present, like this is tabular, not necessarily you do it, you can do it in a single line format. Similarly, you do it for factor 2, fine. Second question is a further extension of it, you will have to do it at your own because anyways the QR code facility is available, right? Fine. Sir, what is the expected return premium of factor 2? This is out of the box. First of all, there is a misprinting. They want to say risk premium. They ended up typing return premium. But it is understood because risk premium is actually a return. So they are asking for the return risk premium for factor 2. That's this particular factor. What is the factor risk premium? Have I taught you ever any formula to calculate factor risk premium? No. Then how do you calculate? Then how do you calculate? Sir, reverse calculate. If I have the expected return of securities, if I have their betas, then can I multiply beta with the factor risk premiums and make the equation of arbitrage pricing model? Yes, where we know that factor risk premium are common across all the security with respect to factor 1, whether it's security B or C or any security, the factor risk premium remains same because factor risk premium belong to market and not the security, correct? Now let's create this equation. Sir, RF is 10%, so 10 plus 0.8 into factor risk premium of first factor and 0.6 into factor risk premium of another factor. 0.8 and 0.6. So this plus the risk free rate is the expected rate of return of 15%. Yes. Similarly, is the expected rate of return of 15%. Similarly, for second security, 10 plus 1.5 into factor risk premium 1 plus 1.2 into factor risk premium 2 plus 10 is equal to 20. Sir, this is one equation, security A, this is security B's equation, we need to solve it. There are two equations and there are two missing variables. Two missing variables using two equation can be solved. When you solve it, everyone in the class, the solution you get automatically for factor risk premium 1 and 2. This is the answer to this question. This is question which I specifically wanted to discuss because it is a reverse calculation question with this long shot position in the weight and also from the study material. Yes. So this question 54th gets done. To be able to solve further question, we need to come to the next concept called as portfolio performance evaluation. We need to evaluate how has the portfolio performed. Simple common sense. The higher return it gives, the better it has performed. So I compare the return of the portfolio. If it is about the future, it is expected return. If it is about the past, it is the actual return. So past return I compare. So can I directly compare the return? No. Relative to risk, how much is the return? That I have to compare. So return in the numerator, risk of the portfolio or security in the denominator. Last modification. This entire return I did not generate because I took this risk. Even without taking any risk, I could generate some return called as risk-free rate. So by taking this risk in the denominator, by taking this risk in the denominator, how much is the return I could generate? So I could generate return of the portfolio minus the risk-free rate. This is the excess return I could generate by taking this risk in the denominator. So official formula is past return or expected return minus the risk-free rate gives you the excess return in the numerator, divided by the standard deviation of the portfolio or the security, which is the risk taken to generate that return, is Sharpe ratio. So if I have different portfolios, I calculate the Sharpe ratio of different portfolio called as reward to variability ratio, right? Those ratios, when I calculate, I can rank the portfolios. The first or the best portfolio is one with the highest number of Sharpe ratio because return is in the numerator, right? Trainer's ratio is an extension or a modification which considers only the systematic risk in the denominator, which is beta, not the total risk standard deviation. Rest is same, also called as reward to volatility. The last is Jensen's alpha, which is also comparing returns but considering risk. It says first calculate the required rate of return as per CAPM, which has the effect of risk taken, yes. And over and above that required rate of return, how much actual or expected return is generated, that gives you the extra return generated over and above required called as Jensen's alpha. That is the third way to evaluate. Please don't get confused. In the characteristic line Sharpe index model, we had an alpha. This is Jensen's alpha used for portfolio performance evaluation. Yes, sir. Now, very important thing. If the returns are percentage, SD is also percentage. If the returns are decimal, SD is also decimal. So somewhere the unit of Sharpe ratio is times. Primarily it is times. Trainers, if the returns are percentage, but the beta is already in times, so trainers ratio unit will be in percentage. However, if the returns are decimal, beta is in anyways times, so the trainers unit is also decimal in that case. Similarly, this is percentage. If everything is percentage, if everything is decimal, this is fine. That's how you do it. Perfect. In all three cases, higher the ratio, better it is. Sir, portfolio performance evaluation. Let's solve some practical question. 56th, an easy question, right? This easy question for one or two particular securities, let's solve in the class. Sir, return of the portfolio has been 19 and 15. The standard deviation has been 2.5 and 2. The correlation of security with the market has been this and this. Market risk 1.2. Market return 14, risk-free rate 9. Sharpe method rank the portfolios. So first calculate the Sharpe ratio. Return of the portfolio minus risk-free rate divided by SD. 19 minus 9 divided by 2.5. Easy. Similarly, 15 minus 9 divided by 2. 15 minus 9 divided by 2. Sharpe is easy. So trainers. For trainers, I need beta. So if I have the correlation of security with the market, if I have the SD of the security, if I have the SD of market, can the beta happen? Yes. 0.84 multiplied by 2.5 divided by 1.2 is 1.75 times beta. So return of portfolio minus RF divided by beta gives me the trainers ratio, which will be in percentage terms. Right. Similarly, another case, first calculate beta, then trainers, then is Jensen's alpha. If I have RM, if I have RF, and if I have beta of 1.75, then can I calculate the required rate of return? Yes. 9 plus 1.75 into 14 minus 9 is 5. So 1.75 multiplied by 5 plus 9 give me 17.75 as RM minus RF as my required rate of return, where the actual rate of return is 19. So 19 minus 17.75 is 1.25. That way you do it for all the securities, and the higher is better is the ranking. That is what question 56 is. Other questions, let us proceed. Sir, 57 is a easy deal. Actually possible returns given. So using possible return, you will have to first calculate expected return, then the beta, then the standard deviation, then the beta. I mean, right from the scratch, you have to do the calculation and solve it for Sharpe trainer. 58th is a good question. Only point is that in this question, return from the portfolio is less and RF is more, which is why when you solve it, the answer of Sharpe and trainer will turn out to be negative. If it is negative, don't hesitate. Obviously, because RF is more and security portfolio return are less, the answer will be negative. Sir, mathematically also understand one thing. 0.208 is a bigger number than 0.405 and 0.625 negative. 0.208 is bigger, negative, then negative 0.405 and 625. So rank it 1, rank it 2nd, and rank in 3rd. Other than this, 58th question is again easy, right? Then the next question we're gonna solve is question 60. Not because it is important, but because it is difficult. You may find it difficult to process at your own. So super fast, everyone, come on. Question 60, come on. Potential has made investment in 2 mutual funds. The following information is available. What information is available? Smart and Growth, these are the 2 mutual funds. Jensen's alpha is 1.1 and 1.5. Trainer's ratio is 0.0714 and 0.0775. Actual return is 8.5, 9.1, risk premium is 4%. What a question. Super fast we're gonna do. Sir, we have to calculate beta risk-free rate security market line. First thing, common sense. Is the data given to calculate beta? No, for beta I need correlation SD or covariance or something. Which means when I have been given alpha and everything, which means some kind of reverse calculation is needed. First, cool. Sir, risk premium is with risk premium. Security risk premium or market risk premium? Sir, since it is common between the two, then it has to be market risk premium, which is RM minus RF. Fine, cool. Let's think what is given. Jensen's alpha tell you that how much is the actual return of the portfolio over and above CAPM return. So if the actual return is given as 8.5, Jensen's alpha, actual return is given as 8.5 and Jensen's alpha is given 1.1. Then can I calculate CAPM return, boss? Accordingly, obviously you can apply common sense as well, that over and above required, if you earn 1.1 and you have actually earned 8.5, then how much was the required? It was 7.4 and 7.6 here. So let's talk about smart primarily in this class right now. 7.5 is CAPM return. Fine. Similarly, trainer's ratio is 0.0714 is the main hidden adjustment here. This is percentage, but this is decimal. When you try to solve and miss to realize that 0.074 is actually 7.14% of trainer's ratio, you end up making mistake. Because for trainer, you need return of the portfolio minus risk-free rate divided by beta. Return of the portfolio, you might take 8.5. So return is in percentage. But the trainer also has to be in percentage for that matter, right? To be able to compare the, like complete the equation, which is where students end up making mistake. So trainers is actually 7.14, whatever is the answer, 7.14 plus actual return minus RF divided by beta. So I have CAPM return 7.4. If I create the equation of CAPM, in the equation CAPM is equals to RF plus beta into RM minus RF. Sir, how did you know you have to create an equation? Obviously I have CAPM return. The next step when I have RM minus RF is obviously to create an equation where RF and beta is missing. And even in the trainers RF and beta is missing. I have two equations where two common variables are missing. If I solve it, how do you solve it is not the point right now. You will get the beta as well as you will get RF. Yes, what you have done for smart, the same thing you'll have to do for growth. Question 60 gets done only because it was a bit tricky and out of the box and had this issue where you had to understand what to do with respect to converting decimal to percentage. We did this question in the class. Next question we're gonna do is an ambiguous question, unfortunately, but it's very logical concept that I want to teach you now, called as portfolio rebalancing strategy. A very logical thing I want to teach you now, called as portfolio rebalancing strategy. People in the class, please pay attention. Come on, everyone. Sir, what happens? Let's apply common sense. At 0 point, if you are able to imagine this topic on the timeline the way I'm trying to teach you, automatically the question solving will become extremely easy. Please pay attention to what I say. Sir, at 0 point, oh my god, wait. So as I said, some construction is going on. Let's continue it a bit with the hope, with the prayers to the God that don't create that disturbance. We are having just half an hour of lectures left with us, right? So please, Bhagwan, kindly manage this disturbance. Cool. So we are back. Yes? Oh my God. Is that really gone? I can't believe. Come on. So what we said, suppose you have 1 lakh rupee to invest at 0 point. You have decided a constant ratio to invest it in the ratio of 70-30 in the equity or in debt. So invest 70,000 in equity and 30,000 in bond. Fine. That is the investment today. Will the share prices and the value of the portfolio change over a period of 6 months? Obviously, yes. Suppose this 70 become 90 in 6 months and this 30 become 25 in 6 months, suppose. So the total portfolio value from 1 lakh, it has gone to 120. Fine. But do you agree? 120 is not in the proportion as it should ideally be. If I check the proportion now, right, it is like 90,000 is 75% of 1.2 lakhs and 30,000 is 25%. Is it the original proportion? No. What should the proportion of this 1.2 lakhs be? 70% is 84,000 and 30% is 36,000. So accordingly, can I say 90,000, which is something right now, should be 84 ideally as per the original weights, and 30,000 should be 36 as per the original weight. So what is the simple way? First you figure out how much should be the investment ideally. Then you figure out, due to change in the market price of the security, how much the value of the investment become. Then you figure out how much should the ideal amounts be based on the revised value of 1.2 lakhs. And then ultimately you do, how do you convert 90 to 84? Sir, you simply convert that by selling securities rupees 6,000. And how do you convert 30 to 36? By buying securities worth rupees 6,000. That buying and selling, when you do, people, it is called as rebalancing. The same activity you do after 6 months further again. That is rebalancing. That is one way to rebalance. Another way to rebalance is buy and hold strategy. That is actually not to rebalance. You buy and you hold it as it is, irrespective of whatever be the market price change. You don't rebalance at all, called as do nothing policy. And the third one is a bit formula driven approach, but is easy. It says that there is a formula that tells you how much is the value of equity you can invest in. For example, if you have 1 lakh rupee, so the formula is really simple. Whenever you want to figure out on that day what is the value of portfolio, 1 lakh minus floor value is given in the question, which is how much is the minimum value of portfolio that you are ready to accept. So 1 lakh is the value of portfolio. We are ready to accept 80,000. So 1 lakh minus 80,000 give me the maximum. 1 lakh minus 80,000 give me the maximum amount of loss that I can bear, which is 20,000. 20,000 multiplied by this multiplier given in the question, suppose it is 2, give me the amount of investment maximum that I can make in equity, which is 40. Equity is red, risky. Green is bond, less risky. So floor value of the portfolio minus the floor value multiplied by multiplier give me the value of equity, and 1 lakh minus value of equity give me the value of debt. That's how I make my initial breakup. Suppose after 6 months the value of the portfolio changes. The total become 1.1, the breakup become 50 and 60. Is that ideal? Maybe no, I will have to check. In the next case, I will say 1.1 lakh. Sorry, in the next case, I'll be like 1.1 lakh is the total value of the portfolio. Whereas floor value is 80. So 1.1 minus 80 is 30,000 multiplied by 2 is 60 in the equity and 50 balancing figure in the debt. That buying and selling we need to do again. Something which is 50 has to be made 60 by buying for 10,000. Something which is 60 has to be made 50 by selling for 10,000. Right? This buying and selling when you do is called as rebalancing, and the weights calculation, amount calculation was using CPPI. This is another concept of portfolio rebalancing strategy, the concept of which if we do in the class, the question of which if we do, it'll make the things further clear. The only problem is 64th question has ambiguities which you have to please consider. Right? Sir, Indira has fund of rupee 3 lakh. 3 lakh rupee Indira has, which she wants to invest in share market with rebalancing target every 10 days. So she has some 3 lakh rupees now. Every 10 days she will rebalance. With this mindset, she invests in the share market, right, for a period of 1 month from now. So overall 3 rebalancing should happen. 3 close friends suggested buy and hold constant ratio in 3 PPI, 3 possible plans. Suppose she immediately start with investment in bond and equity and decide to rebalance her portfolio after each 10 days and to invest in Nifty as equity component. Sir, when it comes to equity component, where do I invest? In a particular share? No, in Nifty, which is the index of National Stock Exchange, NSE, right? And the language is not clear, but what they want to say that Nifty change in tandem, equity component change in tandem of Nifty. Obviously, when you invest in Nifty, right, change in Nifty will automatically be the change in the equity portion of my portfolio. Common sense? Fine, sir. Bond has no beta. Bond will not change. As on date, beginning of the month, Nifty is 5326. Fine. Minimum Nifty within a month can most be 4793 Nifty, which is 5326. At a minimum, it can go to 4793.4. Sir, what is the use? We will figure it out. If she choose CPPI, 2 will be multiplier. If she choose constant ratio plan, then 60-40 will be equity bond. So today if I have 3 lakhs, 60 and 40 should the ideal investment be, which will be rebalanced every time. Cool. Further, portfolio will be rebalanced each time Nifty changed by 5% compared to previous Nifty. This is an important line. They say, will you compulsorily rebalance after every 10 days? No. On this day, check if the Nifty has changed by more than 5% or not. If it has, rebalance. If it has not changed, don't rebalance. Wait for the next, the next time. Wait for 20th day. That you might think the question has become complicated, but it has become easy. If the change is less than 5%, if it is less than 5% change, then do you agree our hard work or efforts to solve the question will be saved? Correct? So let's now look at it. This rebalancing part is applicable to both. 5% change part is applicable to both, whether you follow CPPI or you follow constant ratio plan. Fine. You are required to evaluate portfolio position under each strategy. That finally, at the end of 30th day, what will be portfolio position? Sir, 10 day later, first day of rebalancing Nifty is 5122.96. If on that day, 50 Nifty is 5122.96 and 10 day further, second date of rebalancing 5539.04, 5539.04. Third date not given, no need to do rebalancing, basically 2 dates. Let's find the Nifty change. Sir, 5122.96 minus 5326 divided by 5326 into 100 give me 3.81% negative change. Will there be any rebalancing here? No, we are saved. Which means in the entire question just one rebalancing. One as per constant ratio plan, another as per CPPI, because buy hold does not require rebalancing. Sir, first look at constant ratio. Sir, 3 lakh rupee when I invest today in the ratio of 60-40. So 3 lakh multiplied by 60% is 1.8 lakhs equity and 1.2 lakhs debt. When I made the investment, Nifty was this, but then Nifty become this. How much is the revised investment? 1.8 lakh divided by 5326 multiplied by 5539.04. Give me, where is that? Yes. Give me 1,80,000 divided by 5326 multiplied by 5539.04. Give me 1,87,2,000. My amount of equity has become from 180 at the end of 20th debt. Debt remain the same. So plus 1,20,000 give me 307,200, the total value of the portfolio. Fine. At 20th day. What should be the ideal weights as per CPPI? So it should be what should be the ideal weights as per constant ratio plan? Sir, whatever is the portfolio on that day, multiplied by 60 is equity and rest of it is debt. So multiplied by 60% is what? 184, 320 equity, rest of it is debt. Equity which is 187 has to be made 184 and debt which is 120 has to be made 122. So difference if you observe is 2880. For the same amount you should sell the equity and buy the debt. The rebalancing has happened at the end of 10th day. 20th day, at the end of, basically after further 10th day is 20th day. 30th day, information not given, no rebalancing possible, constant ratio plan done with no ambiguity as of now. Right? Cool. CPPI. Sir, floor value I need. To start with, value of the portfolio is 3 lakh. The floor value is not given, and this is the line to be used for floor value. This is the ambiguity. Sir, what is the ambiguity? This is the line to be used for floor value, that Nifty within a month can most fall by 4793. So it is, although they are saying that the market can at max fall by this percent, they understood it as that I can accept a maximum fall of this much percent for my portfolio. What is this percentage fall? 4793.4 minus 5326 divided by 5 through is 10%. So institute assumed that after 10% fall, my portfolio 3 lakh will become 2,70,000. So that is my floor value that has been assumed, that you will have to please mug up as it is, unfortunately, right? So this is a 10% fall, right? Although this is a calculation buy and hold strategy, the same is used in CPPI, that floor value is 270. So 3 lakh is the portfolio value now, minus floor value multiplier by 2 give me 60 as the equity component. So 240 is the debt. At the end of 10th day, 60 here, 240k here. 10th day, no rebalancing. Here is the rebalancing. What does the amount become? 60 multiplied by 553904 divided by 5326. Sorry, where is that? 60 multiplied by, oh my god, where is that? 5539.04 divided by 5326 gets 62,400. And value of debt is 240, continue to remain same amount. At the end of 20th day, based on this particular value, based on the revised value of the portfolio minus the floor value of 270 which remains same, multiplied by 2 give me equity value of 6400 and balancing figure is debt. In 302,400, if 68,400 is equity, rest of it is debt. So 62,400 add and 240, this is minus, right? You have to add something, buy equity and sell debt of what amount? Of an amount of 2400, and what you have done is rebalancing. Yes, I hope I am able to convey what has happened under CPPI. Sir, why did you not consider change? I missed to calculate, I think, the change here, but change if you are calculating, it will be 8.12%. 5539.04 minus 5122.96 divided by 5122.96. It is 8.12% change, which is why rebalancing is happening here. Yes, in any plan. Sir, third is buy and hold plan. So simply, sir, 3 lakhs. Now problem is third ambiguity. In the buy and hold plan, we don't know how much should the initial investment be. One logic, maybe use the ratio of 60-40, or another logic, I don't know, but institute has done it, is that since you believe 10% is the maximum fall, so 270 is the minimum value of portfolio which can accept. So logic they have applied is you invest to 270 in the bond, because bond are less risky, and 30,000 for which you can take the risk, for that 30 where you can take the risk, invest in equity. This is the logic they have used for buy and hold. So 30 in equity, 270 in debt. Find what the value become on the day of expiry, no rebalancing needed. What the value become after 20 days, become the final value of the portfolio which we have calculated here. So final value of portfolio 301, 302 and 307 we have calculated in all cases, where in the two cases we have also guided the course of action for the purpose of rebalancing. Question 64th, a comprehensive question covering all the plans we have done. Now I'm going to take you. Yes, Vishal, I will try. Vishal, I'll try to what you're saying, 100%. Now I will try to teach you. Now I'm everyone taking you to the last topic for the portfolio management, for which we're gonna do one question, and that completes with all the details the entire chapter of portfolio management. Listen to me, what's happening. Sir, I need to calculate the beta of unlisted entity. If I ask you to naturally calculate a beta, it will be correlation by SD into SD, or maybe summation xy minus n into x bar y bar regression formula. Do you need for all these things, you need the possible returns XY? And for that, you need the data of price and dividend. If something is unlisted, do we have the price dividend data? No. Where is the problem? This is where is the problem. Yes. What do you do in that case? Really simple. Beta tells you the risk. An equity faces risk because of two reasons. One, because the risk the business as a whole has due to its nature of operation, right? And secondly, the risk which is additionally there because debt does not bear any risk. For example, 80 is invested and 40 is invested, total 120. If 120 risk is to be borne by both of them in their proportion, then there is no problem. The problem is risk of 120, which is there at business level, is to be borne by primarily this 80 rupee of equity, because debt primarily does not bear any risk is the problem, right? So to the equity when we reach, it has to face two kinds of risk. Overall, three formulas are there which you need to use in variation. Formula number one: if your business has multiple divisions, each division will have its risk, and each division will have the amount which is invested in that division, or each division will have a weight invested in that division. Correct? So beta into weight plus beta into weight gave you the weighted average beta of the entire business of all my asset, called as beta of the asset. This overall risk is to be borne by both of them collectively in whatever proportion, but is to be borne by both of them collectively. So beta of the asset is equal to the beta of firm. And sir, risk that equity takes, beta of equity into weight of equity plus beta of debt into weight of debt, is the beta of the firm. Yes, these are the three formulas which you have to primarily know. Now, these three formulas can be used in any format. If I have the division beta and their weights, I can have the asset beta. Or it may work otherwise. If I have the asset beta and if I have individual divisions beta, I can back calculate weights. If I have the asset beta, I can have weights, and I have this division beta, I can back calculate this division beta. Correct? It can work this way. Similarly, firm beta, if I have weight of equity and debt, if I have, I can back calculate the beta of either equity or debt. Or if I have equity, debt beta and the weights, I can calculate firm beta. This is how it is. Sir, finally, the flow of the question. First, I taught you broadly the flow, then the formulas to be used, last the flow of the question. A company is listed, right? Sorry, the lights changed. Anyways, please continue with it. A company is listed, right? Sir, that listed company equity beta we know. If we have its debt beta, can we do the weighted average to find firm's beta? Yes. Can I assume that to be the beta of asset or the beta of entire division? Say two companies at business level risk, if they are in the same industry, will be same. In simple language, for simplicity, I can say the beta of Reliance Jio and Airtel for that telecom business will remain the same. Which means if I have the beta of Airtel, suppose it is listed, so can I find the beta of Jio assuming it is unlisted? Yes, so the asset beta will remain same. At equity level, the beta is different because the debt involvement is different. The risk to be borne by the equity differs due to involvement of debt. But at business level, the risk is same. So that way, using a listed company's equity beta, first we calculate its asset beta, and the same asset beta is assumed my asset beta. Similarly, for another division, you find out somehow. And once you have the asset beta overall of your company, you get your firm's beta, using which you back calculate your equity beta, which was what the topic was. Right? The last thing. Beta of equity, weight of equity, beta debt, weight of debt is fine. If the examiner is silent, beta debt is considered 0. Next. Sir, if the weights are in percentage terms, fine. If the weights are in absolute terms, then what do? Equity divided by equity plus debt, where to the debt you multiply 1 minus t for the benefit of tax. Similarly, beta of debt into debt divided by equity minus debt, where to the amount of debt you have to multiply 1 minus t in both numerator and denominator to find the weighted average beta of the firm. Beta of the firm is equal to beta of asset and the division weighted average we know. Last and the important thing, only for the sake of terminologies. Sir, what? Beta of equity is after the effect of debt, if you realize, called as levered beta, and beta of asset has nothing to do with the capital structure, is called as unlevered beta. Yes, that is last. And one more note, sorry, I just came to know, which will be of use in practical question. Whenever examiners say beta in the entire AFM, in business valuation, in equity valuation, in portfolio, wherever, beta means equity beta. Only when it specifically mentions asset beta, then consider it as asset beta, otherwise it is always equity beta. Sir, question number 66, which is a basic question, let's solve in the class. For that, let me open the handmade notes. 66. So if you want to solve this question and if you follow this balance sheet approach, it will be of great help to you, great help to you. See, first of all, the question that we've just done, I'm sorry I missed to open this file, but a very genuine presentation, change more than 5, change less than 5, more than 5, what the value become, how do you do rebalancing. If I would have opened it, the learning could have been more impactful. I'm really sorry for missing that out. I just came to recollect it for 66 only. Fine, what the question says. Please allow me to have water, then we continue to read this question. Just a minute. What it says, equity of KGF Limited is 410, fine sir, done. Debt is 170, fine sir. Printer division 74% value beta 1.5, balance another division beta 1.2. So 74% 1.45 beta, 26% 1.2 beta for the two divisions, fine. One is printer division, another is spare consumable. Debt beta is 0.24. First part, equity beta we have to find out. So common sense, beta of assets of different divisions into its weight will give you the weighted average beta of asset is equal to the beta of firm. Weighted average beta of equity and debt is the weighted beta of the firm. If I already know this, I can find this out. Simple, cool. So division A, beta into weight give me 1.385 as the beta of the asset, which is equal to the beta of firm. Now beta of the firm I know is beta of equity into weight of equity. Absolute terms 410 divided by 410 plus 70. 0.24 plus 170 divided by 410 plus 170 is equal to beta of firm of 1.385. In this entire equation of beta of the firm, which is weighted average, I know only the beta of equity is missing. When I reverse calculate it, the beta of equity turns out to be 1.860 times. Basic sorted question. Next part of this question. A certain equity beta, again, if KGF decide to change the debt equity position, sir, change the debt equity position, which means raise some equity or redeem some equity, similarly raise some debt or redeem some debt. Sir, by raising further debt and buying back equity, raising debt, add the debt and reduce the equity, buying back is reduction the equity, to have its debt equity ratio of 1.9. So, I will change the capital structure such that the debt equity ratio 1.9, which means at present it is 410 equity, at present debt is 170. Something I buy back from 410, but for that I'll have to use the raise the debt for the same amount, and the revised equity and debt give me the debt equity ratio of 1.9. Are you getting? Please. So I have to actually say it otherwise. Debt is 170 plus x, equity is 410 minus x, and the ratio of debt to equity is 1.9. If you calculate x, you will get the amount of new debt to be raised, or you will get the amount of equity to be bought back. Using this equation, you get the debt is 210. So now I have a revised capital structure. 210 revised debt, 170 existing debt, and 410 minus 210 is 200 of revised equity. Read the second part of the question. Assume that present debt beta of 0.35 and further fund raised will have a beta of 0.4. So I have the revised beta of existing and new debt. I have the overall beta of 1.385, I guess, in the question. Yes, 1.385. You have to find out the beta of equity again. So you have to reapply the same formula where the weighted average beta you know and you have to back calculate the beta of equity. Sir, how it works? Let's check how it works. Again, beta of equity into weight of equity, beta of first debt into weight of first debt, beta of second debt into weight of second debt is 1.385. When you solve it, beta turns out to be 3.3. Third part of this question is really theoretical. You'll be able to process it at your own. 66th question, boss, gets done of proxy beta, and that's all we were needed to do in the class for portfolio management. So everyone, let me tell you, really a comprehensive revision. Every possible concept with the best possible detailing which I could share has been shared in this video. Similarly, good variety of question trying to cover one question of every time with the complexities involved, ambiguities, hidden adjustment, everything has been shared. Yes, so that was really all from my side. If you want to get other videos for other chapters, you may please let me know in the comment section which chapters are you further looking for. Yes, so that was all from my side on this lecture. People, thank you so much for watching it up. As I said, if you really think my effort has been beneficial to you, adding value to you, please put your genuine feedbacks in the comment section of this video. Please share this video for your colleagues and juniors. Right? So bye everyone. Thank you so much. I'll see you again. Bye. Take care.